jobs that you have to be on site for. So retail, healthcare. If you look at the damage across the Southeast and the number of businesses that are still without electricity, going to work is going to be a challenge. And so that's what I expect to see, that hours worked really playing a role. And those hours are not just hours alone. They're going to feed into our measures of productivity, our measures of hourly earnings. And so I think that the October jobs report is going to be really, really clouded.
It makes me wonder, if I'm on the Federal Reserve sitting there November 7th, and hopefully we've got an election result in hand, and they're looking at these numbers, what will they get a clean read on, if anything at all?
They might get a clean read on retail sales because that's probably not going to be as affected in the September data as the jobs market. And they're going to be really focused on the health of the consumer in terms of whether they might need to make an aggressive cut or not. If the consumer stays relatively balanced, which they've proven to be very resilient through the summer, then I don't think they're going to need to do anything drastic when it comes to worries about the state of the economy.
Do you feel like there is some sort of weakness, or do you think in the data that you see at ADP, it's just simply companies that are reluctant to make a big move? It sort of becomes this self-fulfilling cycle of not having confidence to hire, and so then that doesn't get back into the economy, so it just sort of chugs along at this very low rate.
We saw hesitancy over the summer. There did seem to be this feeling that companies were holding back a little bit, and not because of economic weakness, just that there's a lot of uncertainty, and that uncertainty can lead you to delay decision making. Well, part of that uncertainty was kind of corrected when the Fed started their rate cutting cycle. We knew now that we were on the path to lower interest rates, and it seemed to thaw some of that hesitancy, and we saw a big jump in hiring in September. Now, what happens in October, I don't know, because the uncertainty has returned in a different form with the hurricanes, and where most of the jobs we're seeing is with service providers. We don't know how global or national companies are going to be looking at the hurricane damage in the Southeast and maybe fine-tuning their hiring plans even more.
Just to put together what you were saying, the idea that retail sales is possibly going to be even more important than some of the employment data, simply because that's going to be so distorted for the Federal Reserve. Is there a feeling that retail sales could drive business decisions? Because essentially, if you don't make a decision to lean into this kind of strength, that's on you, and that companies eventually will have to realize that.
Right. These next 3 months for retailers are hugely important. They make about 20 to 25% of their revenue over the holiday season. And so that, yes, in some sense, they're going to have to skip over any kind of hesitancy and lean into what we're seeing so far, which is consumer strength. And you want to play into that, especially if a big share of your revenues for the year are going to be in the next 3 months. So I do expect some hiring, but I also expect some caution in certain regions. And so we'll see how that plays out over the next 3 months.
You expect some hiring. It's the absence of firing that stood out for us all. Yeah. And then we just see this big contradiction on Thursday with jobless claims spiking. Where are we on layoffs? How do you view things? Because the job openings data that we get, it's a little bit dated. You get a real-time look at things at ADP. Where are we with hirings and firings, more particularly?
Well, the trend overall, and we have to always look at the trend and not just a single data point, especially when we know that that data point could have been affected by weather events. But the trend overall is people are staying on the jobs longer. And that's both voluntary quits and involuntary layoffs. So there hasn't been a lot of moves in terms of the overall headcount. And the hiring we've seen has been expansive hiring, not replacement hiring. So that's good news. Now, there are some sectors that we've seen some downturns in manufacturing and in information, but overall, in terms of the service industry, it's been really, really strong.
The Federal Reserve has a bias to cut interest rates at the moment. Raphael Bostic, who's going to be a key policymaker in the months to come, particularly with the hurricane damage across his region, suggested skipping a meeting. How do you feel about skipping a meeting? Given all the contradictions in the data, the murkiness, why should the bias still be to reduce rates?
Well, about 3 months ago, I actually said this, that it's going to be likely that there would be stops and starts in monetary policy, that they would not be on a smooth glide path because of all of the uncertainties in the economy. Yes, the economy is strong, but every month you get a new narrative about the future direction. And I think the Fed is very susceptible to that. And these weather-related events don't make it any easier. So yes, I do think that that is a real possibility that they may skip meetings in order to figure out what's going on in the economy. And that is related to their strategy, which is to be data dependent. Maybe it's time for a rethink on that strategy to be a little bit more long-term. I feel like we're kind of playing hopscotch with data. We just hop and leap from one data point to the next. I don't think that's a really viable strategy that you want to see with the Fed long-term.
The ECB is not playing hopscotch. They've got a pretty clear message, and they meet on Thursday. How much can we conclude this period of time that the U.S. has truly diverged from Europe when it comes to economic trends?
Well, that divergence has been in play for all year, right? So the labor market is strong. To be candid, I mean, there's some parts of Europe that are doing much better than expected, like the UK, for example, which was thought to be going into recession a year ago, and they made it through that period. They're still going to see the same kind of labor market tightness that we see in the United States. Those are long-term demographic effects. But when it comes to the U.S. economic story, it is unique and separate and apart from any other place in the world right now. You see a healthy consumer, you see strong business investment, you see a stock market that keeps growing, and you see a very strong labor market. So all those things added together put some distance with the rest of the world, and it's really the U.S. that is driving the world economy right now.
How much, when we're talking about China, the fact that there's sort of this deflation and there's a sense that growth is really falling off a cliff, how much do you see that not at all affecting the U.S., that these two economies have really grown apart, even though we are seeing it trickle into Europe in a much more meaningful way?
It's interesting, the U.S. economy, because we think of it as a global economy. But there's parts of the U.S. economy that is insulated from global effects, our energy, for example. And so, yes, I do think that China, being the second largest economy in the world, will eventually affect the United States. But how much is undeterminate. I do think that there's still some tailwinds in the U.S. economy that even allow us to grow past weakness other places.
Neela, you're one of the best. It's good to catch up. It's good to see you.
Thank you.
Thank you. Neela Richardson of ADP. Trying to look beyond 2024 and get into 2025, the range of outcomes for 25. And of course, there are different probabilities attached to different outcomes, but November in the election, you could have tax rate at 28%, tax rate for corporate taxes of 15% with conditions. We might have tons of tariffs. We might have none. We might have what we're left with. I've got no idea. That's the next 12 months.
Yeah, and then add to that what Chris Harvey was talking about, that when you get a lame duck president at a time where some of the hot war risks in the global economy are raging, how much uncertainty does that add into the picture? Basically, all of this should make you want to hide under a pillow, but people are still buying stocks, and that's what we see today.
Not just buying stocks, buying credit too. Credit spreads,
Exactly.
Lisa, your world, they are so tight for high yield and investment grade.
If you're looking for some sort of forward indicator that we're going to see defaults or any kind of stress in the credit world, the canary in the coal mine, you ain't seeing it. So this sort of raises this question of, if you're going to get that weakness, where is it flashing? Because it's not flashing in VIX, it's not flashing in credit, it's not flashing in stocks, it's not flashing in earnings, and it's not flashing with the consumer. Where could it be?
Very close to multi-decade tights across certain parts of this credit market right now. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Authorities arrested a man on gun charges outside former President Trump's Coachella rally over the weekend. The 49-year-old suspect was driving with a fake license plate and IDs with different names. Federal officials said the former president was not in danger and the investigation is ongoing. Marine Le Pen is heading to court. France's far-right leader is appearing before judges today. Her and her party are standing trial over suspected embezzlement of European parliamentary funds. The National Rally Party and 25 of its top officials went on trial last month for having used money intended for EU parliamentary aids and instead paid staff who worked for the party between 2004 and 2016. Le Pen has denied any wrongdoing. A new Bloomberg survey found that Germany is going through a mild recession. It underscores the months of unease in Europe's largest economy. Analysts in that poll see GDP shrinking 0.1% in the third quarter. That follows the unexpected contraction of the same size in the second quarter. The weakness in Germany is largely tied to the cutoff of Russian energy supplies, disappointing export demand from China, problems among car makers, and a scarcity of skilled workers. And that's your brief, John.
Danny, thank you. Up next, a stock picker's paradise.
People might say they're bearish, but when you look at the positioning and look at their equity exposure, it's still relatively high. Earnings need to do a lot more heavy lifting as we turn the corner into 25.
The view from Bank of America just around the corner, live from New York. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Weeks of gains on the S&P 500, the longest weekly winning streak going back to May of this year, looking to add some weight to the rally, up by, let's call it 0.2% on the S&P 500. A lot to work through this week. Bank earnings, some economic data, retail sales, the main event. That drops on Thursday morning. Under surveillance this morning, a stock picker's paradise.
People might say they're bearish, but when you look at the positioning and look at their equity exposure, it's still relatively high. Household stock exposure, depending on which metric you use, is right near an all-time high. There's not as much juice to squeeze out of that valuation or the multiple expansion part of this market, so I think earnings need to do a lot more heavy lifting as we turn the corner into 25.
So here's the latest. Earnings season resuming this week with big banks once again at the top of the schedule. Bank of America expecting it to be a great environment for active investors. Austin Kwon of Bank of America writing, the real action is going to be at the single stock level this earnings season. It's a stock picker's paradise. As long as companies have managed through macro headwinds and see early signs of improvement from lower rates, we believe stocks would get rewarded. Austin joins us now for more. Good morning. Good to see you. Let's start with that. Why is this a stock picker's paradise? Give us some detail.
Yeah, so if you look at the single stock level, what the options market is pricing in, it's pricing in the biggest implied move or biggest earnings reaction in our data history going back to 2021. If you look at the implied vol at the index level for the S&P 500, it's still very, very low, which means that the real action is going to be at the single stock level, not necessarily at the index level. And that's basically a very good environment for stock pickers.
Just to break that down, does that also mean the real action is away from the big tech names? Is that fair to say?
It might be, yeah. I mean, I think big tech is still going to be a big focus this earnings season, but I think the real focus isn't necessarily about how companies did in Q3. It's really about it's about the outlook on the other side of the curve now that an easing cycle has begun. And I think the most interesting companies to watch for is really the rate-sensitive sectors of the economy, so namely manufacturing, housing, even financials. I think those areas are going to be the biggest focus this earnings season.
You had this statistic, which I found rather shocking, that in the third quarter, you saw 67% of stocks outperforming the S&P 500. This speaks to a broadening out that we haven't seen going back to 2002. Just put into perspective what the characteristic of those stocks were that did outperform, considering that they were 2/3 of the entire overall 500.
Yeah, exactly. I mean, this is what happens when the market is so concentrated in those market names. And I think if you think about the internal market rotation over the past 2 years, I think it was really driven by earnings. A lot of people say rates was the biggest driver or even inflation, but if you think about heading into 22,
everyone was worried about the Fed hiking cycle and what that's going to do to long duration equities. And people say that's why tech underperformed in 22. But if that was the case, tech should have underperformed last year as well. I think it was really about earnings. Tech earnings underperformed S&P 500 earnings the entire year in 22, and it bottomed in March of 23, and that's essentially when tech earnings stopped underperforming and started to outperform. And the other 493 just came out of an earnings recession in Q2, and their earnings are expected to re-accelerate in Q4 and into 2025. And I think the narrowing growth differential between tech and others' earnings, I think that's really the main driver of the rotation that we started seeing.
So does this mean that essentially tech earnings are now set to underperform, underdeliver, not beat as much, and essentially could be laggards even as the others lead? In other words, a lot of churn under the surface, even if the index number stays the same.
Yeah, I mean, I don't think that they're necessarily going to miss. I mean, these are basically fundamentally the best companies in the world. So I think they're still going to deliver, but there's also high expectations that they are going to deliver because they have been delivering, and valuations are high, positioning is elevated. So if you look at positioning and valuations in the other 493, it's still very low. There's a big gap between the other 493 and the Max 7. So I think that's really going to drive the catalyst, especially as earnings broaden out.
Let's focus on 2025. A theme for this program for months is that we're flying blind into 25 until we know the outcome of the election. A lot of people come on the program and say low visibility, still don't really know what policy is going to look like. How much visibility do you have, and where are you getting it from? Where does any confidence or conviction come from for 1 year out?
Yeah, I want to say we have higher visibility than a lot of people do. And the reason why I say that is because the manufacturing and the most rate-sensitive sectors of the economy have been in a recession over the past 2 years. I mean, a lot of people are saying that this hiking cycle didn't really have an impact on the overall economy, which is true. GDP is 70% services, 70% consumption. But if you look at underneath the surface, manufacturing and housing, rate-sensitive sectors, they have been in a recession. And that matters for earnings and equities because 50% of earnings for the S&P are tied to manufacturing goods. So that's why we haven't really seen, great environment for profits. Volume is still very low. And I don't think 2025 estimates are that high. I mean, everyone's talking about how it's overly optimistic, 15% growth that consensus is pricing in. I think it might be a touch too high. We're at 13%. If you look at volume expectations for next year, excluding the Max 7, consensus is forecasting about 2.5% volume growth. And that's not too high, especially compared to super easy comp that we're expecting this year, which is up like 0.5% year over year. So I don't think it's necessarily overly optimistic. I think it's just might be a touch too high.
Osung, this was smart. It's good to see you. Come back soon. Osung Kwon there of Bank of America on earnings season and looking ahead to 2025. Coming up on this program, Kate Moore of BlackRock, Stellantis CEO, Carlos Tavares. We'll catch up with Sonia Meskin of UBS and Victoria Fernandez of Crossmark Global Investments. The third hour of Bloomberg Surveillance up next.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
From our
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The market has been trying to push in too much policy accommodation. You do need to see earnings estimates continue to rise, we think, in order to support the market.
We're expecting that the S&P can maintain a higher than traditional valuation setup premised on much more resilient fundamentals than many would have thought.
Investors probably have to lengthen time horizons. It's just not as beneficial anymore to be as near-term focused.
I don't think after a bull market, so to speak, in both equity and credit that has lasted this long, has not sucked in most investors.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Happy anniversary to the American bull market. We had some weight to it. Equity futures on the S&P 500 firmer by 1/10% on the S&P. That's my romance for the morning.
Yeah, that was such romance, man. I'm blown away.
All-time highs at a close on Friday. We add some to that move this morning. Just 1/10 on the S&P, up 3/10 on the NASDAQ 100. I can do better. On a Russell, up by 0.04. The week ahead looks like this. Lots of bank earnings. We get some more tomorrow morning. You'll hear from Bank of America and Goldman. And lots of data, including retail sales on Thursday and an ECB rate decision. Retail sales, the data point of the week for a lot of people.
Neil Richardson actually saying it might be more important for the Federal Reserve than the jobs figure that comes out next month, just simply because it will be so messy that it won't give any clarity. What will be less messy will be the fact that one thing you cannot get between is an American and their credit card, and that is essentially what we've been hearing about and seeing in all of the data and all of the rhetoric coming out of companies.
The data's already messy. I think we're still trying to figure out that jobless figure on Thursday. Big gap higher. Much higher than anticipated, the wrong kind of upside surprise. How much of that was just the hurricane impact? And how much of it wasn't?
Honestly, basically there's no sign of real mass firing. So a lot of people say, look, it is messy because of the hurricane. That said, you're not seeing a lot of mass hiring either. So if you have the stagnation, which way is it going to flip? Do you see a flip in the market expectations? I know the bond market's closed today because they've got their priorities straight about having a day off, but the stock market does not. Either way, 10-year Treasury yields have risen 45 basis points since the low about a month ago, less than a month ago in September. That is a 41% retracement of this year's rally. So all the people who are talking about the Fed not needing to really worry too much about inflation, they could cut aggressively. that's kind of gone off the table in less than a month.
You're writing letters to the stock exchange?
I am. I think that it's ridiculous.
Let us know if they respond.
Okay.
Coming up this hour, Kate Moore of BlackRock as the bull market marks its second anniversary. Stellantis CEO Carlos Tavares as the automaker shuffles its C-suite, and Sonia Meskin of UBS looking ahead to retail sales. We begin this hour with stocks hitting all-time highs as the S&P 500 celebrates its second anniversary over the weekend. Kate Moore of BlackRock is looking ahead to earnings. Even with our balanced optimism about 3Q results, we are more focused on how management guides for 4Q and into 2025. We want to hear management teams express confidence about their ability to deliver revenue growth, to manage expenses, and to navigate policy and political uncertainty. Three very different themes. Kate joins us now for more. Kate, good morning. It's good to see you.
Don, I'm a little sad. I didn't realize I was coming here on the anniversary of the bull market. I would have dressed differently.
How should we have dressed, like with red ties and hearts and stuff like that?
Yeah,
Thank
maybe
you.
a
Give us
tiara.
more.
I mean, it's quite a celebration. In fact, and I feel really good about the fact that equities continue to make new all-time highs and that the fundamentals look really solid this far into the cycle.
Let's start with top-line revenue growth. Where's it coming from? How much confidence do you have that we'll get more of that through 25?
Well, this was the big question, right, as we went through second quarter reporting, where, companies were putting up good bottom line numbers, but the top line was really disappointing on expectations. This kind of quarter, we've seen a bunch of solid activity. We've seen good incomes. We've been, encouraged by the fact that inflation has continued to slow. And I think we're going to see solid, but not blockbuster revenue growth in the third quarter. The real chance is going to be if we get into next year and some of the uncertainty is removed. I think people will feel more comfortable about increasing their activity. I mean by people, I mean both business decision makers and individuals.
One of the reasons why maybe didn't realize it was the second anniversary, and John didn't sound overly enthusiastic about it, although happy anniversary. I do think it hasn't felt this way. Right. It has not felt like a bull market. It has felt like a grind of lots of different narratives that are coming together with whipsaws in between, and a couple of behemoths that have absolutely led the charge while everything else had a soggy performance. When will it start to feel like a bull market?
Well, you're right. There's been a huge amount of discomfort in the leadership and the strength of that leadership, the persistence of the leadership. A message that we've talked about many times, and I feel like I have been a broken record, is to say the companies that have been leading the market are the strongest fundamentally. These are the companies putting up the cash flow. And I expect that will continue into 2025. How many times this year, by the way, have the uncomfortable, equity investors said it's time for rotation, it's time for rotation, the market's supposed to broaden out? Well, it's only going to broaden out if these top companies actually don't have the same growth trajectory that they've had over the last 2 years. And I don't think that's the case. I mean, I think parts of tech and the AI and the AI adjacent themes still have a lot of legs to go.
So given that, are you basically recommending that clients overweight stocks, even at the behest of bonds, at a time where the biggest uncertainty might not be in the stock market, but at this point really is in the bond market that's closed today for a celebration of the second anniversary of the bull market?
Yeah, that's correct. The bond market got the celebration correct. I would say this, we have been more neutral in terms of our fixed income allocation. I still think you're going to get the best juice from the equity market. But again, you have to pick your spots. The one thing that has happened throughout this past year that people have not always been comfortable with is that you have had to be tactical and you had to have to be on your feet. I don't think the kind of the set it and forget it strategy is going to be the way to go forward in the equity market. And so for this, I would say, I told you I love the tech and the AI and AI adjacent themes. I think there's opportunity more in the banks as we move forward. And I'm looking if we continue to have stable growth indicators for opportunities in some of the cyclicals. But there you have to be selective.
You identified three themes: top line growth, expense management, and then navigating policy and political uncertainty.
That's right.
How are they going to navigate the politics of the next month, maybe the next 4.5 years?
Well, I don't think they're going to make a ton of decisions in the near term. I mean, this is the pattern we always see. The second half of the year during a big election cycle, you don't tend to get a lot of capital expenditure or new CapEx. It's mostly maintenance, for example. And consumers have said in a lot of polls and surveys more recently that they're kind of holding off on making big decisions till they understand what their tax rate is going to be if there's any changes in policy. So I think we're in a bit of a holding pattern, John, for at least, the next few months. But next year, once we understand not just who is going to be president, but the composition of Congress, I think there's going to be a willingness to kind of embrace whatever that policy is and move forward.
This, to me, is one of the biggest question marks. We hear about policy uncertainty. We hear about questions about potential for growth in terms of earnings and margins. We hear about a reticent investor who's holding on because of risks. And then we see a fifth straight week of gains in the S&P 500, the longest streak, as John was mentioning, going back to May. How do you square what seems like a lack of confidence in surveys and a demonstration of confidence when it comes to allocations, inflows, as well as just performance?
Look, sentiment has to be a big part of everyone's investment process. And when you have all these sentiment indicators, the surveys, even some companies saying that they're concerned, that's the moment you say there might actually be opportunity, right? When everyone is saying it's an all clear, there's literally nothing for us to worry about, we're going to pile all of our risk into the riskiest parts of the stock market, then you kind of have to back yourself off. I think in this case, the fact that people have been more reluctant bulls, that there has been, a fair amount of argument around the leadership, that sets us up well, I think, for positioning. And we're not overly, I think the stock market is not overly owned at this point. There's still a little bit of cash on the sidelines. And if these tech companies in particular put up big numbers in third quarter reporting, there's room to re-up those positions, I think, going into year end.
Kate, this was great. It's always good to see you.
Yeah, great to see you.
Thanks for being with us. Kate Moore of BlackRock. Here stateside, looking at equity futures up by a little more than 0.1% on the S&P 500. We need to head over to Europe. Under surveillance this morning, the road ahead for Stellantis. Shares are down by more than 40% so far this year. The automaker shaping up its management team in a push to drive performance. I'm pleased to say that joining us now is the Stellantis CEO, Carlos Tavares. He joins us now from the Paris Motor Show. Carlos, welcome back to the program, sir. It's always good to hear from you. The last time we spoke, we've had some changes. The EU has voted to impose some tariffs on Chinese automobiles. What I want to understand from you is whether you've had some Chinese car companies knock on your door, dial your phone number, and ask you to sell some of your brands to them. Is that happening?
Well, first of all, thank you for inviting me. Yeah, that happened in the past. Some Chinese car companies asked me to sell them some of our brands, which I believe is a significant asset of our Stellantis company, and therefore I rejected the request, and we are keeping our brands and, of course, doing good business with them. So the answer that I gave them is no, thank you very much.
Have they followed up on that request in the aftermath of that vote at the EU in the last few weeks?
No, they didn't. No, they didn't. But it's obvious that with our Leap Motors investment and the equity that we have in Leap Motors, and most importantly, the fact that we control all of their exports outside of China, it is quite clear that we have the manufacturing footprint, not only in Europe, but all over the world, to bring to our partner and to ourselves the manufacturing sourcing that we need to go and do a good business out of the constraints that we need to manage. And of course, tariffs are a constraint, and you can go around tariffs if you manufacture inside of the bubble that has been built. This is what we are offering to Leap Motors. Everything that is sold outside of China is under our control through a 5149 JV called Leap Motors International, and we are, of course, creating that value thanks to our dealer network system and our manufacturing system all over the world. This is a competitive edge of Stellantis that most of our competitors cannot reach right now.
Carlos, give us a little bit more detail on how tariffs might impact the company. And I just want to say, for the benefit of the audience, Leap Motor, of course, is a JV, a joint venture you have with a Chinese manufacturer. Some of those cars are behind you as we speak. Carlos, how are you thinking about retaliatory measures coming from the Chinese? How well insulated do you think you are from the potential of that developing?
Well, first of all, what we see when we work with our partners from Leap Motors is exactly where their competitive edge is. Their competitive edge is very localized in a certain number of systems of the car, which is good to know because that's where we need to work harder to be more competitive compared to what we do today. So we see that. We also see that they have the ability to be much more affordable than the Western world and then meet the expectations of the consumer base that we have in the Western world, which is basically the consumers want to buy EVs at the price of ICEs. And that's exactly what they are able to do today. We are also able to do that with some of our offerings in Europe, but we need to expand this competitive edge to many other brands and many other models. So that is a competitive advantage that our company has. And by having this ability with them, we can leverage their cost competitiveness, their speed to go to market, and at the same time, if needed, go around the custom duties that the Western world is trying to impose on us. that also means that compared to other Western world actors, we are in a much better position for the future than some of them.
Carlos, can you just elaborate on that? Are you basically saying that the only way to really provide cost-effective EVs to a European consumer is to get around some of the up to 45% tariffs that the EU just voted on?
What I'm saying is that we are leveraging a strategy that is based on two major pillars. There is one pillar with Leapmotor that brings EV technology at the price of ICE, despite the tariffs that you are mentioning, because we can go around the tariffs by manufacturing the cars inside of the bubble. That's one. On the other side, we have a dedicated platform that we call the Smart Car Platform that we are using to bring compact cars to the market, like the new Citroën C3 that we bring to the market at 23,000 euros, which is the core of the market in terms of pure EV, and that price is extremely competitive. It's on par with the Chinese capability, and that kind of offering is also profitable for Stellantis. So not only we have the pillar of Leapmotor, which is very strategic, we also have the internal pillar, which is the Smart Car Platform that we are now using, for example, for the C3 Citroën hatchback, but also for the C-Cross crossover version, and many other models will follow, Fiat models, but also Opel models, and that is going to bring a lot of competitiveness to the market. So what I'm saying is that Stellantis is in a perfect condition to leverage affordability with profitability and zero emission in the near future.
Carlos, how important is it in order to retain profitability and increase going forward? How important is it to pare back certain brands that aren't performing as well and that don't fit within those targets? I'm thinking in particular in North America.
In North America, we have a very specific problem, which is a very operational problem, not at all rocket science. In North America, we got trapped by a marketing plan on the second quarter of 24 that was very audacious, very daring, and it didn't work, it failed. So we got trapped by that marketing plan, and then we needed some time to discuss the best way to rebound with our US dealers, which we did. I did it personally in August this year. Now we have a new, let's say, more conventional plan that is active, and it's working very well. Over the last 3 months, we could reduce our US dealer inventory by 52,000 vehicles. And we will be, before the end of this year, before Christmas, below the ceiling of 330,000 vehicles, which we consider is the ceiling for a normalized inventory. This problem is now being fixed. It's not rocket science. We have discussed it with our dealer body. I think we have the right dynamics right now, and we expect this to be fixed this year. So that was what happened. Regarding the brands are very healthy. The Ram brand, the Jeep brand, with all the new models that we are bringing, the Dodge brand, but also very soon the new Chrysler models. I think they are very healthy. We just need to do a proper operational work in terms of way to go to market and collaboration with our dealers. I think we have the capability to do that, and I believe that Ram and Jeep are already leading the way in terms of the market share recovery that you can see as we improved our market share between September and July from 7.2 to 8.0%. So market share is up, inventories are down, they will be normalized by Christmas, and I think we are back on a quite nice trend, but now we need to deliver the results. This is what our investors and the community of investors expect from us.
Carlos, are you open to selling any brands?
Not necessarily. I'm not necessarily open on that. Of course, we consider any offerings or any proposals like in any open-minded business team, as we consider we are. So if there are proposals, we'll study, but we are not seeking any sale of any of our brands right now. That's very clear.
Because last time we spoke, you talked about corrective action. You've got a mandate until, I believe, the end of 2026 as the CEO of this company. I shared some of the details, the stats on the overcapacity across the European auto manufacturing sector. You're familiar with them. They're worth repeating. Nearly a third of the major car plants from Europe's Big Five are producing half the vehicles they have the capacity to make. And I'm sitting here, Carlos, just wondering, when are we going to make the decision to make the corrective decisions that seemingly need to take place? One of two things needs to happen. Either you cut capacity or European politicians, governments are going to come out with the right kind of demand-side incentives to buy the vehicles? Because that's not there right now. When do we actually face the reality check? Is it this year? Is it next year? How much longer can we hold on with excess capacity?
Your comment is very valid. It is quite clear that right now we only ask two things to the governments, and specifically the European governments. We ask stability of the rules. We do not ask for any kind of postponement because we are ethically committed to contribute to fixing the global warming. So we don't ask for any postponement. We ask for stability from one side. And from the other side, we ask the governments to stimulate the demand, which is not to help Stellantis, but to help the consumer so that the consumer can buy EVs at an affordable price, i.e. at the same price of ICE. So that's what we are telling them. We'll see if they have the capability to do so. And if not, then we'll have to take decisions, as you say. I assume that those decisions will be made in the next few months. I think before the end of the year, if nothing happens, we'll have to make those decisions. That's absolutely clear.
Carlos, just to sit on that, because this is really important. Your message to the European government and governments, national governments across the continent, they've got 2-3 months to get their act together, otherwise you're going to have to close plants.
We had a very good concrete example that you reported in the media about our dialogue with the UK government about the ZEV mandate. The ZEV mandate in the UK had a threshold that was the double of the natural market demand. So if you need to put in the market the double of the natural market demand in terms of pure zero-emission vehicles, of course, it has a cost. It has a cost, and if there is a cost, then we need to compensate for that cost with additional decisions that will compensate for that cost. That dialogue has been ongoing for several months. We are now reaching a point where we have to make a decision, and again, that will happen in the next few weeks. If the governments want us to sell a mix of BEVs that is above the natural demand of the market, they need to help to stimulate the demand so that we can reach that level of ZEV mandate without destroying the profitability of the companies. If that is the case, then we need to restore that profitability to ensure the sustainability of the company, because we are trying to meet a ZEV mandate that is not what the natural market demand is. So that's the situation, which is, I think, a big opportunity for Stellantis, because Stellantis is among the companies that has the highest number of BEVs on sale. By the end of this year, we'll have 40 models on sale. On the B segment only, hatchback and SUV, we have 16 models on this most important segment in the European market. So we have the offering, we have the technology, we have the appealing products, we have the design, we have everything. We just need to stimulate the demand and help the middle-class consumer to fix the affordability problem that we still have in our hands.
Carlos, I've got to squeeze one extra question in. I know you're busy. Are European auto manufacturers investable right now? Your stock is down by more than 40%. What on earth do you tell investors? As we're in between this horrible window right now where either you're going to have to do one thing or the government's going to have to do something else. But in between, it's so difficult for an investor to make a decision to buy your stock. What's the message you give investors right now?
Well, I perfectly understand why they are puzzled, and I'm sorry for that. It is quite clear that we are going to go back to them very soon to tell them that we have fixed the US dealer inventory issue. This is the number one thing we need to fix. It's very operational. It's not rocket science. And I understand this is the number one priority. I think we are on the right trend as we reduced the inventory by 52,000 vehicles in the last 3 months. The dynamics are good. We expect to reach a level that is below the ceiling of 330,000 by the end of this year. As soon as this landing is in my hands, which I think it will very soon, I will go back to them to explain to them that that problem is fixed, and then I will leverage all the other competitive edges that we have on our company, which I believe are very big in terms of technology, in terms of bringing the right EVs with the right performance to the market, in terms of strategic partnerships like the one we have with Leap Motors. So They will see me back very soon, but first I need to take care of my homeworks because that's my responsibility, and I'm excited about fixing those issues.
Well, hopefully we see you back very soon as well, sir. Once again, you've been very generous with your time, and we appreciate it. The Stellantis CEO, Carlos Tavares, on the latest difficulties for the auto manufacturing sector across Europe and arguably worldwide, with the exception of some of the Chinese brands right now.
Yeah, and repeating what we heard earlier, the idea of some sort of way to incentivize consumers to buy electric vehicles in Europe so that they can do so at an affordable price. That sort of being a benchmark idea that a lot of people are looking for.
Let's turn to Craig Trudell, who followed that conversation closely, Bloomberg's very own. Craig, your thoughts on that we're getting to crunch time here. Got a few months left. Either the European governments get their act together and make a decision, or we're going to see some serious cuts.
Yeah, I think your last question was the right one, which is, how is a stock like Stellantis possibly investable in this sort of paradigm? And I do think that, with all due respect to Mr. Tavares, I think the answer there was, I think, less than satisfactory. Essentially, you're going to have to wait for me to do my homework and sort of, come back to you with more. I think it is the case that this is a company that is very much caught in a sort of paradigm of challenges with the state of the industry over here, and they are far from alone. But for him to sort of downplay the extent of the issues they've had as simply a matter of a second quarter marketing plan that was too ambitious that they didn't pull off, I think just understates the issues that Stellantis has been having that go back far more than just the second quarter of this year, where they've been making too many cars, making too many higher spec, higher price cars, and trying to sort of prolong this period of good times for the industry longer than it was clear the market had tolerance for or appetite for.
How much are the purchase incentives that seem to be a theme this morning something that policymakers in Europe truly are prepared to do?
I think we're hearing, actually, even just in Germany, just in the last couple of days, an interest in sort of, taking another look at the subsidies that were taken off the table about a year ago, and a realization that was, a grave mistake. I think you need to look no further than, the way that the German market has played out since that decision was made, and it's a very clear conclusion you have to draw that EVs were just not ready to stand on their own 2 feet yet. When you pulled those subsidies out of the market, we saw a huge pullback in demand, and it's just clear that the EV industry needs subsidies in order to sustain the momentum that we've seen the last few years. And we're not ready for the consumer to purchase those cars without some help.
Yeah, or plants are closing and jobs are going to be lost. It's that simple, Craig. Craig Trudell of Bloomberg. We talked lots about Germany and VW. Stellantis in Italy, just to share some numbers. The Fiat 500 was the jewel in the crown for Fiat for a long, long time. They produced an electric one. They've had to suspend production. That was the news out of Torino over the last few months. Manufacturing of Fiat and Maserati for the first 9 months of the year in Italy down 41%. We're talking about taking out the depths of 2020 in the pandemic. That's how bad output's been.
There's a real structural problem, and time is running out, and that's what policymakers are being asked to address right now.
It's a difficult moment. It's very, very difficult to invest in some of these manufacturers until we get some real visibility on the future. Sonia Meskin of UBS, Victoria Fernandez of Crossmark join us next. We're looking ahead to US retail sales and another read on the American economy.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Programming note in 60 minutes' time. Don't miss this one. Keir Starmer, the British Prime Minister, sitting down with Bloomberg's Stephanie Flanders, 9:30 Eastern Time. That's 2:30 in London on Bloomberg TV and on Bloomberg Radio. It's been a very difficult first 100 days for this leader. He's getting together business leaders from all around the world in the UK this morning and trying to convince them that the focus is on growth. There's a big budget coming up a little bit later this month. We're looking ahead to that and looking for some clues from this guy a little bit later. That conversation 60 minutes away. 1 hour away also from the opening bell with equity futures right now on the S&P 500 firmer by 0.2%. On the Nasdaq, we're up by a third. Just a little bit of underperformance on the small caps on a Russell. With your morning movers, let's cross over to Danny Berger. Morning, Danny.
Good morning, John. Boeing under pressure this morning. Over the weekend, we learned that they were going to cut about 10% of their staff. That's 17,000 employees. Pre-market shares down 2%. Nick Cunningham of Agency, an analyst there, saying that this is not a coherent plan and it is all very hand to mouth. The CEO, Kelly Ortberg, saying that they could take more dramatic action if things don't improve. They're heading into month 2 of their strike. Meanwhile, Affirm, the buy now, pay later company, higher this morning, up nearly 2%, an upgrade from Wedbush. We know lots of people are using buy now, pay later. Wedbush says the macro environment is getting better for these companies. Lower rates are helping. The credit condition is still good with all expectations of a soft landing. Finally, rounding things out with SiriusXM, the radio satellite provider, up nearly 3.5%. This all thanks to Warren Buffett and Berkshire Hathaway, a filing late on Friday that they've been buying up the stock for the good half of last week. They spent 3.6 million shares with $87 million is the price tag on that. They now earn 32% of the company, easily a majority for that company, though these shares, John, they've been down some 50% year to date, even with that buying.
Danny, thank you. Appreciate the update. The latest there. So we're dropping Bank of America and we're buying SiriusXM.
That's right? What I was thinking about. I mean, it's not really analogous considering the scale of the position in Bank of America versus what it's a different sort of size and scope, but it does sort of fly in the face of this idea that Berkshire Hathaway is hoarding cash rather than trying to invest in companies on the margins.
We'll get some numbers from Bank of America later this week, some numbers from Goldman, from Citi, from Morgan Stanley. That's the next 48 hours for earnings on Wall Street. Markets also looking ahead to Thursday's data points, including retail sales and another round of jobless claims. Sonia Meskin of UBS writing, the next marker for the strength of the consumer will come with retail sales. It follows up a streak of relatively robust September data. We continue to see upside risk to initial claims from storms, strikes, and seasonality. Sonia joins us now for more. Sonia, storms, strikes, and seasonality, not necessarily about then general cyclical weakness in the economy. Is that fair?
Yes, it's fair, and it will be difficult to disentangle the temporary factors from the underlying trajectory of both the consumer and, of course, the labor market. So we would expect the initial claims to begin to rise simply because of those idiosyncratic factors that you have cited. But of course, we believe the market will be quite focused on the underlying trend as well.
So, Sonia, you've got to come up with a jobs number for November 1st, for the month of October. I feel your pain. How are you going to do that?
It'll be hard. It'll be hard while we're working through it right now. And of course, the story is evolving just as we work on it. But It could very well be that the September numbers were the cleanest that we might get this year.
Sonia, how much, we were talking to Neela Richardson earlier, she was saying that in some ways retail sales might be more instructive than the payrolls report that we get next month simply because of just how messy it is. Do you agree with that?
Well, the retail sales could be volatile, and the jobs numbers are, of course, in focus because that's part of the FOMC's mandate. But the consumer is really a key lever here. As long as the consumer is strong, as long as the consumer is spending, we will continue having a strong economy, and that would fuel into growth and jobs.
Given that, do you think, Sonia, that it's actually realistic that Raphael Bostic could be the front runner here, that a pause next month in terms of rate cuts might be warranted as they assess just how much weakness or not is in the economy?
Well, it's interesting, you know, the minutes came out last week, and of course, our interpretation of the minutes was in part the 50 basis point cut in September was a catch-up to what they perceived to have started too late, not having cut in July. But given the noisiness of the data and given that the seasonality factors are changing and it's hard to cut through all of that to the underlying trend, we think the most likely path is still for them to stick to 25 basis points at each of the next subsequent meetings.
My takeaway from the minutes was that Chairman Powell bullied them all into going 50. How wide of the mark am I, Sonia? Isn't that what it sounded like?
Well, it sounded like there may have been more disagreement, in fact, around this 50 basis point cut than perhaps Chair Powell expressed in the press conference right after the meeting. We saw that in the SEP. We also heard this from the Fed speakers after the meeting as well, including last week.
You said something interesting about the month of September. You said it might be the cleanest read we get on the economy this year. Sonia, are you saying that October, November, December data might just be distorted right the way through to year end?
Well, I think the NFP may be distorted, especially, you know, for the next number that's going to come out in November. It will be difficult to disentangle some of the effects from the weather and the strikes to the actual trend. And of course, we didn't see that come through in September.
Given that, Sonia, how much are earnings really going to be the number one indicator that a lot of people are going to look to, given the fact that we are starting earnings season and that so far it seems like everyone's looking for that weakness and not finding it?
Earnings are very important. They're important in the sense that they also gauge, A, the consumer, but B, the health of the corporate sector as well. And we do believe that fundamentally, because the data is on the economic side is noisy, earnings are, just as you say, are important as a secondary factor, even for the economists to look at.
I know that the bond market's closed. They have it right today. Stock market's still open. I am wondering, though, about your interpretation of the massive sell-off that we've seen in bond yields over the past month. The fact that we've seen a 41% retracement in this year's rally, a 45 basis point increase in terms of 10-year yields going back since September 16th. Do you think this is the market getting it right? That essentially the Fed can cut rates a few more times, but really can't cut that significantly because of the ultimate underlying strength, despite how high relative rates are?
Well, the question around the financial conditions is a very good question, right? Because in essence, if the Fed is easing, financial conditions should ease too. But if the Fed is, you know, easing but rates are going up, that may not necessarily be happening. And we believe the market is effectively just like the Fed is watching every data point and trying to gauge in real time what the Fed is going to do in the next few months. That's difficult to do. And one of our scenarios, not our central scenario, but one of our scenarios is a re-acceleration in the economy. And in that scenario, the Fed will have to, you know, even after cutting then pausing, would have to start raising rates again because it would turn out that the consumer is quite a bit stronger than originally expected. The wealth effect is still there. And that would put upward pressure on inflation as well. Again, not our base case. Our base case is actually slowing to trend and the FOMC stabilizing the policy rate at 2.75% to 3% around next summer. But one of our risk scenarios is for sure re-acceleration.
How election dependent is that risk scenario, Sonia? Does that depend on the outcome of November?
So interestingly, we've done some research around that, and it seems like from the proposals that we've seen, the blue sweep versus red sweep, the effect is actually not as strong, and as I think some of in the media would lead us to believe. The biggest impact would be from all-out tariffs.
Sonia Meskin of UBS. Sonia, appreciate it, as always. Need Anne-Marie around the table. She's going to be back tomorrow to break down some of these scenarios. Re-acceleration risk, the real risk. Adam Poston's talked about the same thing. He does think it's election dependent.
That essentially if Trump gets elected, then inflation goes up, tariffs get implemented, you start to see the Fed being forced to raise rates next year. It's hard to get your mind around what scenarios to actually put into place. My big question mark are what are the checks on either candidate to know whether their policies are going over well? There is an assumption in business circles that Donald Trump uses the stock market as a check on his policies, and that if the stock market sells off, he will adjust course. Will that be the case? Unclear. What's Kamala Harris's check? Is there going to be something in that place as well?
Victoria Fernandez joins us now to continue the conversation. Joins us from Crossmark Global Investors. Victoria, welcome to the program. I was going through your notes on the labour market, the labour differential. Plentiful versus hard to get jobs. See that in consumer confidence, not great. ISM components for employment, not great. Cyclical employment, not seeing big gains there either. So even if we park jobless claims and say that's just the hurricane effect, are you suggesting the cracks in the labour market are bigger than some people suggest they are?
I think they are. Those elements that you're talking about, Jonathan, are perfect examples of kind of that underlying effect that people maybe aren't looking at as much as just that headline number. Yes, there's seasonal effects that go on, but look at those components. Cyclical employment is a key element, and we've talked about it before as something to really watch and give you an insight into how the economy is growing. When you have non-cyclical employment that is leading, when you have those jobs like healthcare, education, government jobs, those are those non-cyclical components. That's not giving you the strength in the market that you really want to have this sustainable move forward. And that's exactly what we're seeing. Cyclical components down, non-cyclical up. Temporary hiring is another one that's seen as a leading indicator in the labor market. That's continuing to come down. And even at the small business report that came out last week, they're telling you the same things. We're stabilizing hiring. We're not going to do much there. Our CapEx intentions are coming down. Revenue looks like it's going to be difficult to maintain. Those are all elements, in our opinion, that say the labor market probably does have wider cracks, which is why we continue to be a little bit guarded about this market, because we know that that can lead to more layoffs.
Well, that view versus the price of the story. Let's talk about the price of the story. Equities, all-time highs. Credit spreads, both investment grade and high yield, incredibly tight. Is that a source of comfort or a source of anxiety?
I guess if I'm anxious about the labor market, that does give me a little bit of comfort to say, well, you know, people are looking at these elements and saying, we see this, but it's the credit market that I think a lot of people are saying, look, they're not seeing any worries there. Look at the gap that we see right now between the VIX and credit spreads. It's a really large gap, and you usually don't see that. In our opinion, you know, credit spreads typically tend to be more correct on that, and I think that's what the market is saying. The VIX is going to come back down. That's positive for equities. So the market continues to have this momentum, but you look a little bit under the hood and we see, look at the number of stocks that are trading at 20-day highs. It's really low. It's like it's 16%. So again, is this sustainable? Or is the market just getting a little bit ahead of itself like it has multiple times over the last couple of years? We're not saying don't be in the market. You can't stand in the way of the momentum that's there. But I do think you need to be guarded because of these elements we're talking about.
What does that mean, Victoria? How do you remain guarded as you do see cracks in a labor market that aren't being discussed, at least in earnings that we've seen so far?
Right. So if you're going to be invested in the market and you're going to be in equities, we want to look at some of those areas that maybe you're seeing some leadership changes. And we've seen that a lot in industrials, which typically do well when the economy is doing better. But again, find some industrials that have the strong balance sheets, the good cash flows. We like financials. I know, Jonathan, you always ask me, why financials if you don't think the economy is doing well? But we see the markets tending to look through some of the not as impressive components of the earnings that we saw from JP Morgan and Wells Fargo last week. And those balance sheets are strong and continue to do well in a steepening yield curve. So financials look well. But look at some of the places like Staples, healthcare. Those sectors have come down. We think there's opportunities there that you can add to have a little bit of upside. And Lisa, it wouldn't be an interview with you and I both sitting here together if we didn't talk about adding some fixed income to your portfolio. I know spreads are tight, but what we're seeing is they continue to hold these tight levels. So I think you can add some fixed income and get some cash flow in your portfolio.
Fixed income on the credit side or fixed income on the rate side, given the fact that you have seen a backup, particularly on the longer end, on the 10-year yield? Or do you go into credit because you're getting an extra spread with companies that have pretty good balance sheets, albeit very narrow relative to recent history?
Right, and I think you can do a little bit of both. We are adding to our credit positions, but we're adding in high quality, right, in investment grade names that we like, where we're not concerned about cash flows for those companies. We know they can meet those principal and income components. We're not dipping our toe into high yield, just like we're not going too much into small caps either on the equity side. So we're trying to limit the credit risk that we have there, but also take advantage of that steepening yield curve, go out a little bit further on your duration and lock that in. The 10-year yield seems to be a little bit overbought right now. We knew we would have a change as the market repriced rate cut expectations, so lock in a little bit of that yield on the longer end.
You mentioned financials, Victoria. Tomorrow we're going to hear from Citi, Goldman, Bank of America, Morgan Stanley the day after. Victoria, what weren't you convinced by on Friday when we saw numbers from JP Morgan and Wells Fargo? What was unconvincing to you?
Well, I think there's some elements in there. Obviously, your net interest margins, your net interest income, people are really focused on those numbers. Some of those did not impress to the same level that many people were expecting, especially on the Wells Fargo side. But you're still seeing credit card elements that are doing well. You're seeing deposits and credit growth that is hanging in there. You know, obviously, when you look at the market elements within the financials, that area is doing well and generating growth. So I think there's positives there. We like these names. We're invested. I do think there were some elements that people said, you know what, this might be a little choppy over the next 18 months or so, but these banks are going to be fine. And that's why I think you can go ahead and hop in there. We always have to watch credit cards, especially when you're looking at Bank of America that's really consumer focused. Delinquencies moving up a little bit there, but still seem to be doing pretty well. We'll see how those numbers turn out this week.
So you're not spooked by the comments from Ally Financial a few weeks back in conference season?
Well, Ally Financial is a little bit different. We actually don't have exposure to Ally Financial in our separately managed accounts. We like those larger banks. Again, going back to our focus on balance sheets, those are the areas that we want to focus. JP Morgan, Bank of America, those being our largest holdings within that sector. So we would stay away from more of what we call the regional banks or some of the smaller banks and focus on those that have that strong cash position.
Victoria, you didn't mention energy anywhere in there. Have we gone past that time where energy companies were leveraged in some way to the global cycle and now move basically to a tune of their own?
Yeah, it's interesting. I mean, a lot of it depends on what's coming out of OPEC headlines. But look, we have these geopolitical events. Maybe you get a day or two of some volatility around energy names, but then it seems to flatten out again. So you're right, there seems to be this disconnect that is coming here. But if we want to look at companies and focus on balance sheets, energy companies are doing well in that sense. They have that strong cash flow. Those balance sheets and cash ratios look good there. And so I think you can have some exposure. I mean, I'm sitting here in Houston. I don't want to say ignore the energy companies. Put some exposure there. But if there is quite a bit of volatility, again, we don't know what's going to happen on the geopolitical front. So that could give even more volatility than what we've seen as of late. So maybe be a little cautious there. But I think over the long term, these are names you want to have in your portfolio.
They won't let you outside. Victoria, it's good to see you. Victoria Fernandez across Smart Global Investments on energy there at the end. Just before on the financials, the banks on the S&P 500 On the week last week, up by almost 5%, the best week of the year. Missed that. Biggest weekly gain of the year so far for the banks on the S&P last week.
They beat pretty much across the board, a couple of wobbles here and there, but across JP Morgan, certainly very much excess versus what people had expected. There's a prospect that it could continue. And there aren't that many negative clouds. The fact that Wells Fargo looked for consumers to show weakness and couldn't find it tells you a lot.
More bank earnings through the week. You'll hear from Citi, Goldman, Bank of America and Morgan Stanley with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. OPEC has cut its forecast for oil demand growth through year-end for a third consecutive month. The organization now predicts that global oil consumption will increase by 1.9 million barrels a day. That's down around 2% from its previous call. OPEC's effort to shore up falling oil prices have been undermined by countries that have failed to deliver their cutbacks, like Iraq, Kazakhstan, and Russia. Other headwinds include slowing growth in China and swelling supplies from the Americas. Renault has unveiled a made-in-France EV priced under 35,000 euros. The R4E tech is meant to help the automaker better compete with budget offerings from Chinese manufacturers. It will have a range of about 250 miles on a single charge and include a ChatGPT-powered digital assistant. Renault is introducing a range of affordable EVs to counter a slowdown in demand. And SpaceX pulled off an incredible technological feat on Sunday after launching its Starship rocket into orbit. The company achieved its first ever chopsticks landing, catching the rocket's over 200-foot fall booster out of the air with giant mechanical arms at the launch site. The recovery marked a historical milestone for spaceflight, with the reusability of the rocket booster seen as a critical step towards developing more advanced space travel. And that's your brief, John.
Hey, Danny, thanks for this morning. I could watch that on repeat again and again. Just absolutely phenomenal. Up next on this program, setting you up for the day ahead. We'll get you the week ahead with big bank earnings reporting, a lot of economic data, and one big central bank decision in the mix as well. That's up next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Wait. always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar IQ, Monday on Bloomberg.
"37 minutes away from the opening bell. Equity futures just about firmer by 0.2% on the S&P. On the Nasdaq 100 up by 0.4. On the Russell, the small caps up by 0.1%. Earnings season picking up through the week. I'll get to the calendar in just a moment. Following 5 weeks of gains on the S&P 500, looking to add some weight to that rally this morning. As we count you down to the opening bell, let's get to that calendar. The week ahead looks like this. Today, we'll get Fed speak from Kashkari and Waller. On Tuesday, Bramo sitting down with the San Francisco Fed President Mary Daly. Look out for that. That's must watch. Plus earnings from Bank of America, Citi, Goldman Sachs and United Airlines. On to Wednesday, we'll hear from Morgan Stanley. On to Thursday, an ECB rate decision. Will they cut interest rates? Why wouldn't they cut interest rates on Thursday? Big debate going into Thursday around that theme. Plus, we'll get retail sales and another round of jobless claims. After jobless claims spiked higher just last week, we'll see if we get a repeat this week with another hurricane disruption potentially also on the cards. And we'll get results from Netflix and TSMC before we get to Friday, where we get housing starts and building permits. Pretty stacked week for the week ahead.
And it has three prongs to it. It has the policy aspect of it, ECB. Not only will they cut rates, but how much will they signal that they will continue to cut them going forward. It has the economic data, the retail sales that Neil Richardson was saying was more important, arguably, for the Fed than the next payrolls report, just because that will be so messy. And we cannot overemphasize the earnings this season, given how high expectations are. Some people argue they're not that high, and how strong they've been so far. And we have not seen that consumer weakness. So you double barrel this idea of not only the banks, but ASML, of TSMC, a forward look to maybe some of the tech names, and you start to get a more fuller picture of exactly what it looks like on the ground right now.
Let's unpack some of the points you've made and maybe just sit on the data. I think your point on the economic data is really important. It's interesting how economists on Wall Street are preparing their clients for an October payrolls report in early November that will make absolutely no sense and will offer you no real read-through, no clean read-through into the US economy. Why aren't we getting more of that from Fed officials? Why aren't Fed officials out there saying the same thing, that the last clean data read that they got on the jobs market was the last one before going into November 7th. Shouldn't they be doing the same thing?
Yeah, should they have a cohesive message that gives a little bit more direction? Maybe. They don't. Right now, it's unclear exactly how much people are on the same page, how much, as you pointed out earlier, Fed Chair Jay Powell really was the one driving the ship and everybody else got in line. Unclear exactly what the compass is. In a data-dependent Federal Reserve, what is the data that really is going to shift the needle? I do think the earnings might take on greater importance, as well as the anecdotal evidence, the beige book, as people start to understand where the forward-looking momentum is for the consumer at a time where business owners don't have a lot of visibility into what's going to happen.
We're setting this market up for a really messy week. So you get tons of economic data, you get lots of earnings between now and the start of November. Then it begins. November 1, jobs report. Could be a total mess. November 5th, election. May or may not get a result the morning after. November 7th, the Federal Reserve is going to sit down as a committee on a Thursday this time, and try and make the right kind of policy decision with everything all in mind.
Yeah.
That's going to be a difficult week.
Or do we have a pause, like Raphael Bostic said, at a time of great uncertainty? A lot of decisions for them.
A lot to work through this week as well. Tomorrow, Max Kettner of HSBC, Ken Leon of CFRA, Sarah Hunt of Alpine Saxon Woods, Kathy Bosch-Jansit of Nationwide. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Happy Monday. We have futures hovering around record levels. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shanali Basak. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the bull rally faces an earnings test this week. The likes of Goldman, United, and Netflix provide fresh clues on the health of corporate America.
No respite for Boeing, the plane maker announcing job cuts and steep charges as it lurches from one crisis to the next.
Plus, an exclusive interview with Keir Starmer. The Prime Minister speaks to Bloomberg about his plans to reignite investment in the United Kingdom. All that and more coming up. Let's take a look at where markets are trading 30 minutes until the bells ring. Of course, we have green on the screen, fresh off the 45th record close for the S&P 500, currently adding another 0.2%. Of course, big tech is your outperformer so far. The NASDAQ 100 currently up about 0.5%. You have NVIDIA, you have Tesla rallying this morning, helping to boost the benchmark. Meanwhile, let's take a look at the VIX, because even with all this good news, you do have an elevated VIX right now, Matt, currently trading with a 20 handle.
All right, so many investors tell us it's all about earnings. We kicked off earnings season officially with the banks on Friday. You can see here at the bottom of this chart earnings revisions, and for the last 4 weeks they have been down. That has not stopped the rally. We continue to make new highs. I think Katie just had 45 new highs so far this year. So we have a very low bar, it looks like, and falling even lower to hurdle to beat earnings expectations.
So let's take a look here under the hood. We do have a few things moving. Boeing moving lower after announcing job cuts and a $5 billion charge this quarter due to financial stress and strikes. You have Boeing down 1.5% pre-market. Looking at MicroStrategy as well, among the biggest gainers in the crypto world, cryptocurrencies and stocks have had a rally. MicroStrategy up more than 6%, and it's not the only one. We're also going to take a check here on SoFi. Just announced a $2 billion agreement to offer personal loans through funds from Fortress Investment Group. SoFi now up almost 9% pre-market. There will be more where that came from with the private markets, Matt.
All right, yeah, private markets for retail by SoFi. Very interesting stuff there. Look, we're kind of meandering, looking for a theme. We've got earnings coming out. We've got some housing data. We've got an ECB meeting, we're reaching, right?
Really, if we're talking about the ECB on Monday morning, listen, we don't have any earnings today, a little bit of breathing room. We have a lot of earnings this week, though. I mean, Shonali walked through some of them. And when you look at the scope of this earnings season, there's a great story on the terminal about the split between CEOs and analysts. Basically, analysts looking a bit downtrodden here, really revising earnings projections lower. And then you have CEOs saying, it's all good.
It's interesting, even though this week is fairly light, like 4.6 trillion worth of market cap reporting this week, the next 2 weeks are very, very heavy on earnings. And you have DataTrek coming out with some data this morning I found interesting. It's really the fourth quarter. The fourth quarter is supposed to have pretty excellent earnings as far as the S&P 500 goes. But this quarter is pretty muted, only about 3% earnings growth, guys.
Yeah, the bar a little bit lower there.
All right, but it seems nonetheless everybody is buying stocks, right? Let's talk about this with Cole Smead. He is the CEO of Smead Capital Management. And Cole, in your notes, I see a St. Louis Fed figure here that shows U.S. households hold more stocks relative to other financial assets than they have since the St. Louis Fed began keeping records in 1952. What does that stat say to you? Do we hold too much in terms of stocks?
Yeah, and thanks for having me this morning, Matt. It argues it's a historical precedence that you rarely see. The other two junctures you saw this high of ownership relative to the past history would have been 69, which was the highest to that point, or 1999, which was the highest to that point. And so looking back at those two prior instances, what you saw no matter what was negative real returns in the S&P 500. And in one case, there was nominal returns that were positive. In the other case, there were nominal returns that were negative, and that was obviously the 2000s. And so we look at it as a contrary indicator. When American households in this data own large amounts of stocks like they do, it shows you it is exuberance, it is confidence to a level in the stock market that you will rarely see. Now, am I saying that every American household owns stocks? No, that's not what I'm saying. I'm saying that it shows the extremity of wealth. The extremities would be Elon, would be Jeff Bezos, would be Bill Gates and Steve Ballmer. Those are the extremities of wealth, and it just screams that when you run into those extremities, broad equities, as noted by the S&P 500, are a terrible 10-year investment.
I will say, though, Cole, I mean, I hear what you're saying on positioning, showing exuberance in this market, and certainly the best start to a year for the S&P 500 since 1997 would tend to agree with you. But even still, you think about some of the features of other bubbles that we've seen, if we want to call them that. You're not seeing, for example, the silly season in IPOs that maybe you've seen in bubbles past. I mean, how do you square the circle that we're missing some defining features of that exuberance?
Yeah, it's a great question. History never repeats itself, but it rhymes. What we saw in 2022 was a lot like 1969, where the bubble of IPOs, to your point, and SPACs and all the other, the VC money raising, you can just put it all together. The activity on Wall Street peaked in 22 like it did when the 60s ended. Now, that didn't stop us from going on to the Nifty 50 in 1972, which, just for the record, peaked on my birthday, December 11th of 72. And then we went to a 2-year nasty bear market and begat the decade of really the lost stock return decade of the 1970s. So I kind of look at this like 1972, the bluest of blue chip, creme de la creme American businesses being as overpriced as they ever get. And you can wake up 25 years later, like Jeremy Siegel did in his book Stocks the Long Run, and he argued you should have paid at the top because you almost beat the S&P 500. That's great for an academic. I live in the real world. Our investors live in the real world. If in 25 years we can say we almost beat the S&P 500, I will be out of a job. I will be calling Michael Bloomberg to ask if I can get in the media business. So that's the issue here is in the real world, those things don't apply. And I think we can wake up with the bluest of blue chips in 5 to 7 years being down 55%, like Coca-Cola did from 72 to 79. Was it a great business? Yes. Was it going to grow a lot? Yes. Did it have a great balance sheet? Yes. And it lost 55% of its market cap.
I hate really talking about stocks as a monolith here. We could talk about the S&P 500, its performance, or the Nifty 50, the Dow Jones, or the NASDAQ. Yeah. The fact of the matter is that these companies change over time. You're a stock picker. Want to cite something that's been going on in the market, the S&P equal weight versus the S&P 500. Just over 3 months, you've actually had twice as good performance in the equal weight index. You've seen a rotation coming on. You're somebody that has already been invested on a lot of those names that those rotation trades have been coming into, like financials. Where do you see this going?
Yeah, to your point, it's not to say that all stocks are unattractive. That's not the point in this. It's just really the dollar-weighted opportunity, or what most institutional investors can do, is a very poor strategy. To your point, I mean, think of financials right now. You know, this idea of a recession, it's a fleeting idea. It's really hard to find a recession. I call it the great unicorn. We know it's out there. We just can't find it. And that's the inherent issue. So like in the financial space, it's like we're running this carry trade. The carry trade is 7% of our GDP is spent in deficit. Can you get a recession when you're doing that? I find that hard to believe, and based on the politics in this season, I can't see it ending. And therefore, you're in an elongated cycle of economic growth. Yes, it's not real in many cases because it's federally spent GDP growth. But that being said, it's a great way to make money as inflation is not at bay, in our opinion.
We don't see any inflation in the energy sector. I saw premium unleaded at $4 a gallon yesterday, which is a pretty decent price for my region here. What do you think about energy investments now? Obviously, we've seen a little bit of volatility, but for the most part, I think people are bearish on demand. OPEC, I believe, recently announced again that it thinks demand is going to be slower growing, only 2% for 2024. So is fuel demand fading, and what does that mean for your energy investments?
Well, they've come out and said slower growth. They didn't say, it isn't going to grow. And I just look at the world as we're at 40 million barrels a day of demand. We got to go to 50 at some point as the world grows, because ultimately oil and gas are a good proxy of economic growth. And so I think less about the demand side, though, Matt. I think a lot more about supply. I mean, use the United States. We're the largest grower of production looking back 20 years. We are the largest grower in the Permian. And if the Permian cannot grow at the rate it did, that means where are we going to get the extra 10 million barrels a day from as we look forward over economic growth? So I think that's the biggest thing we think about is the lack of supply. And if you look at the reinvestment, CapEx as a percentage of operating cash flow in the oil and gas space, it's just not there. If you go announce you're going to do more CapEx, you're going to find a falling stock price on an oil and gas business. To the point earlier about the equal weighted versus the dollar weighted, energy isn't owned in either in any meaningful way. It's a great way to get rich in a decade that stocks are going to do terribly.
Well, Cole, let's talk about that a little bit more. I mean, why do you think that's the case? You take a look at energy equities. They had a great run a couple years back, but since then, I mean, declining last year, this year up 11% or so, underperforming the overall index. I hear that you're saying that this is a market focused on supply, but given the might of American oil producers, wouldn't you expect a better performance and more enthusiasm?
Not at all, because that's being overshadowed by the fact that the majors have been the worst performing over the last 3 to 4 years. So that's where the dollar-weighted money is. Again, you're back to your issue of where's the money versus where can you make money. And so I think a lot about that. From a market cap perspective, I think this is true for the S&P 500 as well. But if you really look in like a $5 to $50 billion market cap, there's lots of opportunities in energy where you made a lot better money, just like that's been true in the S&P 500. But that's not where the money's at. So if I can go out and buy mid to high teens returns and pay something like low single-digit book value multiples, I can do really well because I'm ultimately going to get the return of the business. Versus if I got to go out and buy Microsoft that produces 30% return in equity, and I got to pay like 10 to 12 times book, I better be right about my exit multiple, or else I'm going to have a lot of trouble if return on equity declines for any reason, or multiples contract because the inflationary pressures aren't at bay.
Cole, give us some names here. I'm really curious about what you're watching. We were just talking about how we're entering the thick of earnings season, particularly next week. What has the most upside in your portfolio?
Yeah, I mean, I frankly think what we're going to see in buybacks and also consolidation in the energy business, this is like a Boone Pickens market. You can dig for oil cheaper on the New York Stock Exchange than you can in the field still. And I think what we see the majors should be doing is consolidating more. Ultimately, we're buying the companies that they're going to have to acquire. I mean, that's broadly speaking, outside of Conoco, which is our only major that we own. So we are in Ovintiv, we are in Apache, we own Devon. Our biggest holding in the space is actually Occidental Petroleum. I think the other thing you'll see is cross-border mergers. I mean, we're up in Canada in names like MEG and Synovus that we also own in our U.S. portfolio. And then we own a company called Strathcona. Billionaires have been made in this business rarely, and you can go out and buy businesses that billionaires are involved in. And you just don't find that in most companies. Strathcona has that with Adam Waterous. And so we think the space is going to probably end up with 5 to 7 players, whether you're in Canada or the United States. The flip side is go look at what the regional banks have been doing since last fall. 1 year ago, it's been a great place to compound money. And again, you're getting mid-teens returns and you're paying something closer to book. That is so vastly different than paying 4.8 times book for the S&P that's producing almost similar returns.
Cole, we have to leave it there, but great conversation as always. Positioning for consolidation, that is Smead Capital Management CEO Cole Smead. Meanwhile, a check on futures to kick off this trading week. Looks like we have a green day on our hands, but it's very early. The S&P 500 up about 0.3%. Big tech is your leader so far, currently up about 0.5%. Can't say the same for the small caps, but the Russell 2000 in the green as well. Meanwhile, let's take a look under the hood. We'll do that with Abigail Doolittle.
Katie, let's start out with some stocks that are moving on corporate and deal news. Southwest Airlines up 1.2%. This is Elliott is seeking a special shareholder meeting in their proxy battle. In that battle, they've nominated 8 directors, and they're looking to replace 8 old directors. It's their first proxy battle since 2017, and this is the first special meeting that they have asked for in this particular proxy battle. B. Riley Financial up 18%. The beleaguered financial company has struck a deal with Oaktree on the Great American Partnership. They're basically going to do a reorganization into this other company. They'll receive $203 million cash plus a stake. Turning to some stocks that are doing a reversal from Friday's action, the shares of Tesla are up 1.4% last week, down on some disappointment, early near-term disappointment on the robo-taxi concept and the sense that there's light on detail at this time. Alibaba down 1.3%, falling on a little disappointment around China stimulus hopes. And then finally, the crypto space, it is higher. Bitcoin up by a couple percent on the China stimulus that there is, plus the betting odds favoring Donald Trump, and he is thought to be pro-crypto. So on this, we have the likes of MicroStrategy, Merrill Holdings, and CleanSpark all up about 5% or more.
Abby, thank you so very much. Now coming up, Boeing plans to cut its workforce by 10% as the manufacturing strike enters its 2nd month. We're going to have more on what's next for the plane maker. Stick with us. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Let's get now to high interest and look at what's making headlines around the world. And the Nobel Prize in Economics has gone to 3 economists studying Europe's colonial legacy. Simon Johnson, one of those winning economists, joined Bloomberg Radio earlier to talk about his research.
Technology has hurt people. We've had excessive automation in the past 40 years. We've not generated enough new good jobs, so jobs where you actually get paid good money and you can live well. And we've got to do better on that. I think that that's really a fundamental driving importance, irrespective of the election outcome.
The 3 researchers were praised for their analysis of how economic prosperity can be achieved. B. Riley Financial will sell a majority stake in its Great American Holdings business to funds managed by Oaktree Capital Management. B. Riley will receive about $203 million in cash and get 47% of the common units of a reorganized Great American. Bloomberg reported the talks earlier this year. And SpaceX stunned the world over the weekend when Elon Musk's aerospace company managed to catch a portion of its rocket using giant mechanical chopsticks. It's a critical milestone in its quest to create a rocket capable of flying to the moon and then to Mars. SpaceX also won key approvals for its 2 rocket systems in recent days. Shonali?
And we're going to look again at Boeing pre-market because the company will eliminate upwards of 17,000 roles as it grapples with regulators, manufacturing strikes, and financial strain. Let's discuss this all with Bloomberg Global Aviation Editor Benedict Kamel. Let's think through for a minute just the scope of challenges being faced. The most recent kind of plan to cut jobs here, how much does this really give Boeing some room financially as it begins to really weather this storm?
Yeah, Boeing came out with this late on Friday, and there are a lot of parts in this announcement that we don't understand yet and don't know. So 10%, as you said, that's about 17,000 jobs. But cutting jobs also costs money. You know, they'll have to pay severance. That part is unclear. It's also unclear which part of the business they will have to cut jobs. Is this more in the commercial part? Is this in the space and defense part of the business? Those are all questions that are unanswered at this point, and the company will probably work through some of these during this week. They're due to announce earnings next week on the 23rd. They already gave us a bit of a glimpse into their financial state last week on Friday. They said that their earnings are down. They actually had another big loss. And crucially, they had huge charges, all in all about $5 billion in charges around the commercial and the space business. So as you say, this is a company that is really in a very tough spot. The 10,000 or the 10% job cuts are happening at a time when the strike is going on. And obviously, this is not going to go down well with the workers who are sort of raring for a fight.
Yes, well, that's what I want to talk about, because you think about how much cash Boeing has. It had $10.5 billion in the third quarter, better than expected, but still low levels for a company that's trying to avoid going to junk rating. But talk to us about how this interacts with the strike. It seems like, of course, Boeing in dire straits here, and the union has relatively lofty demands relative to this company's fundamentals.
Yeah, you're right. I mean, the $10 billion, they're just above that crucial $10 billion threshold. That's the money that Boeing says they need to operate on a day-to-day basis. And dipping below that would obviously require them to seek fresh funding. And that's something that we have reported is in the works, that they are exploring some kind of a capital raise. The floor of that is about $10 billion. It could be substantially higher than that. The big unknown in all of this is, what is the strike going to cost them? How much longer is this going to drone on for? We are now in the 5th week. There's really no sign of an agreement at this point. There are no talks taking place. So really, we're in uncharted territory in terms of what this might cost, how long it'll take, and frankly, some observers are asking, why is Boeing not coming back to the table? The cost of paying the workers more is manageable, and it's probably a lower cost than the damage that's done by this extensive strike. So really, it's a balancing act for Boeing. How much are they willing to give workers? They're not that far apart. About 30% is what's on the table from Boeing, and about 40% is what workers would like. So it's not that big of a delta, but for the time being, no talks taking place.
Benny, I'm wondering about the knock-on effects. You and Sid and our team globally cover, obviously, the entire industry here, and Boeing isn't able to make deliveries, right? They said on Friday 777X deliveries are going to be delayed until, I think, 2026. How is this affecting their clients, their customers?
Well, we already heard from their key customer, which is Emirates today. They are by far the biggest buyer of that aircraft. This is the sort of updated derivative of the 777, the 777X. That plane was already delayed. Originally, that plane was supposed to come out in 2020. That gives you a sense of just how late it is. And Emirates was saying, very unhappy about this. We're going to have some robust conversations with Boeing, I imagine, about compensation. But across the industry, everyone's very unhappy about these delays.
Yeah, big time. And Ortberg saying on Friday that they need to be clear-eyed about the future. It's going to be a fascinating story to follow. That is Bloomberg's Benedict Kammel with the latest on Boeing. Now coming up, casino and gambling stocks under pressure this morning. Details next in our Social Climbers. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
All right, 4 minutes until the bell, and you have green on this screen. The S&P 500, 0.3% higher. The NASDAQ 100, even better, of course. NVIDIA, Tesla rallying. Small caps not doing too much, but still green. Coming up, an exclusive interview with UK Prime Minister Keir Starmer. This is Bloomberg.
in this facility, which is part of your $2 billion investment in the last 2 years. It's a massive amount.
Yes, because, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing countries.
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on-site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, and you're about to see something historic. I believe that we will open at the highest level we have ever seen the S&P 500. If we continue into the green after those opening bells, this would be the 46th record day this year. Let's take a look at the New York Stock Exchange. You have women in finance ringing the opening bells, but they have a dude doing it. That doesn't make a lot of sense. I thought Megan Griffiths was going to be the film producer there ringing the opening bell. Down at the NASDAQ, you have Micron ringing the opening bell, and we'll be paying obviously close attention to see how many chips they can make for the AI craze. But most importantly, Katie, have we done it? Have we achieved a 46th record high?
For at least 29 seconds, it looks like, yes, we have been at a record high on the S&P 500, currently higher to the tune of 0.3%. And that's right. If that holds through 4 p.m., that would be the 46th record high. This has been the best start to a year since 1997. And you're seeing that enthusiasm in the NASDAQ 100 as well. Of course, big tech rallying today, lifting the benchmark by about 0.5%. The small caps not exactly seeing the same exuberance as Cole Smead would say. The Russell 2000, I'm going to go ahead and call that flat on the day. But let's take a look under the hood, because Boeing shares moving on its announced 10% in job cuts, which equals about 17,000 positions. Of course, the plane maker also said it will incur a $5 billion charge that is due to financial strain, manufacturing strikes. You add it all together, shares only down about 1.5%. But Shonali, this stock is down by more than 40% so far this year.
Katie, you said stocks were flying, and so is crypto. We're keeping an eye on MicroStrategy, this stock, as it's rising about 4% alongside Bitcoin. Traders see Beijing's latest stimulus efforts as an opportunity for blockchain investment. Matt, you see more crypto stocks flying along with it.
All right, and companies worth more than $4.5 trillion, Shonali was downplaying that, but it's still a huge number, are going to report earnings this week. Third quarter profits are forecast to expand 4%? That seems a little bit high. It is the slowest rate in a year, but I saw 3.2%.
That's actually right. Analysts, at least according to data gathered by Bloomberg Intelligence, expect S&P 500 earnings to come in at a 4.2% increase year over year, but that's down from a 7% forecast that they gave in mid-July.
It's better than the chart we just had up.
It is better than the chart.
Because that chart said, I think, 3% and change.
Well, clearly you can quibble over the numbers there, but in any case, of course, we have seen those revisions getting downgraded, and it's not really slowing down the S&P 500 at all, of course, with all those record highs.
30 trillion worth of companies, more than that, almost 32 trillion over the next 2 weeks. So if you think this week will feel like we get a glimpse into the economy, the next 2 weeks will give us a lot of information on what to know ahead.
at least we'll have something new to talk about, you know? Of course, the Fed seems to be in risk management mode. We've just been hovering around these record highs, so at least we'll have some catalysts coming up.
China delivered us nothing.
Exactly, exactly. Of course. Let's go now to London, where Stephanie Flanders is standing by with a very special guest, an exclusive interview happening right now.
Thank you so much, and we are delighted to have the Prime Minister, Sir Keir Starmer, with us at the International Investment Summit here in London. Prime Minister, in your speech earlier today to the summit, you vowed to do everything in your power to galvanise growth in the UK. But if you look at the sharp decline in business and consumer confidence since you were elected, since you started talking about all the tough times ahead, the tax rises ahead, you'd be forgiven for thinking you'd done the opposite to growth. So I guess I'm wondering, are you feeling now you might have overdone all of that a bit?
Well, today was very much a statement of intent to say very clearly that economic growth is the #1 mission of this government, and that means that we're open for business as a country. We want to drive that investment into our economy, and we want to see that in jobs, secure jobs in different parts and all around the United Kingdom. So that's very much the message from today. There's been a drumbeat of inward investment over recent weeks, which I think demonstrates that although, yes, of course, we've had to signal that there are tough decisions to make because of the damage that's been done to our economy, and we've just got to be straight with people about that. We do have amazing assets in this country in terms of our skills, our people, our universities, our cutting edge when it comes to technologies like AI, for example. And that's why making that really clear statement of intent today was very important. And I think quite a lot of the inward investment decisions we've seen, running into tens of billions, are vindication, if you like, of the approach that we're taking in partnership with the investors and the businesses, many of whom are here today.
I mean, one of the things that you've been clear about was that tax, and the Chancellor's been clear about, is that difficult decisions will be needed, tax increases will be needed to pay for that investment in public services that people are expecting. And given all the taxes that you've ruled out, there's a lot of concern here in the business community about increases in capital gains tax and in wealth tax. Now, I know you're not going to want to go into the details of the budget, but are you reassuring the investors here that they have nothing to worry about on that score?
Well, I'm not going to get into the details of the budget. You wouldn't expect me to. But neither am I going to shy away from the fact that we've got difficult decisions to make. The last government left a £22 billion black hole. And we're not going to walk past that. We're going to have to deal with it. So that'll be tough. But what I've been able to be very clear with investors and businesses is because growth is the #1 mission, then decisions, whether it's on the budget or anything else, will be determined by whether they help growth or not. So that's the lens through which we're seeing this. But I have to say, the discussion here, we've had intense discussions all day long, last night as well, with a number of people in the room that we've got to know over the last 2 years. So this is the first time we're meeting. All of the discussion today has not actually been about tax. It's been about planning. It's been about the regulatory environment. It's been about getting infrastructure moving much more quickly and the sort of apparatus of government working to that common end. That's the real discussion that's going on here. That's the real focus. And actually, contrary to perhaps what people might think, tax is not the first thing that businesses and investors are raising with me. The first thing they're raising with me is it really your #1 mission? Is it going to be stable and strategic and for the long term, to which the answer is yes? And are you prepared to do the tough things on execution and the deliverables, which is about the length of time it takes from investment decision to actually seeing a project materialise? That's where I think we've been able to do a lot of reassurance that, yes, we understand that, and we're determined to do the follow-through on growth that is desperately needed for investors, for our country, and for the jobs of the future.
But Forgive me, Prime Minister, but I think a lot of people, they may not be talking about it to you, but a lot of people are worried in this sort of vacuum that we've had, quite a long wait for the budget. There's quite a lot of what might be just crazy speculation around where capital gains tax might go, for example. So something like a 39% rate. Can you reassure people that whatever the change is, it won't be anything that significant?
Well, quite a lot of speculation is getting pretty wide of the mark, but...
So you say that 39 is wide of the mark?
It's getting to the area which is wide of the mark. But I'm not going to fuel the speculation, because we can go on like this for a very long time until budget day. Everybody knows that until budget day, none of it is going to be revealed. It was important that when we came into office, into government, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought through budget. So that's why we put the timing as it is. It's the right timing. But equally, it's been really fantastic to have this investment summit just a few weeks before the budget, where the mood music here is very upbeat. People are talking about a real opportunity now to invest in the UK, comparing it as a sort of relative advantage across the world. We want to seize that opportunity and take it forward with many of the investors that are here.
You're looking at the books, but obviously people are also just sort of checking when they think about, I know you're not going to reveal what's on the budget, but when they're thinking about what you've committed to and what you've not committed to. For example, the pledge not to increase national insurance contributions. Most people I talk to think that if you increase the employer side of that, the employer contribution, that would be breaking that pledge. Can we, without getting into the budget, can I just check that is your understanding, that that would be breaking that pledge?
Well, you're saying without getting into the budget and tempting me.
Well, it's just you're explaining your pledge.
We made very clear commitments in our manifesto, and we intend to deliver on those commitments. Beyond that, I'm afraid you'll have to wait for the budget for the details. For very obvious reasons, we're still weeks away from the final assessment in the budget.
I guess that you said it's the right timing for this summit. It does feel a bit odd that for those people in the room, people who are doing deals today, you can't promise them that the basic tax environment for entrepreneurship, for business, for wealth, in a couple of weeks' time won't be completely different.
Well, they're very interested that corporation tax is capped. They know exactly where that is in the long term. They're very interested in the fact that we're able to say that because we've got a good, strong majority in government, we're able to make decisions based on years, not months, with a clear strategy. They're very, very interested when I talk to them about being a mission-driven government, a government with a real sense of purpose measured over years, with one central purpose, which is wealth creation translated into jobs in different parts of the United Kingdom. That's the sort of stability that they're looking for, and that's the conversations we're having. They're very pleased to hear that from a government, are very pleased about the clarity. There's no end of people here today who said the clarity of the message is really welcome. It's now the follow-through, which is actually the execution of it. What are you prepared to do when it comes to planning? What are you prepared to do when it comes to regulation? It's not just the number of regulations, it's the inconsistency of regulation that we need to deal with. And when I'm able to say with real confidence and certainty and clarity, yes, we're going to deal with that, that leads the decisions, in my view, to make the sort of investment that we've seen in recent weeks, which is very welcome. These are not just big numbers, although they are big numbers. They translate into jobs around the United Kingdom, good, well-paid, secure jobs. And that's the change we promised at the election and the change that I'm determined to deliver on.
So you talked about mission-led government, and ethics-led government's obviously been a feature. You had a sort of unfortunate slip on the way to this summit involving DP World, which I'm not going to go into, you'll be glad to know. But there is another company, Shein, which was considered to be such a rogue operator in the US that it hasn't been able to list on the US stock market. It was too controversial, its working practices. But it seems that that your government is continuing their sort of open arms policy for wanting Shein to list here. Is that right?
Well, I think we've got to get the balance right. And clearly we've got to have standards, high standards. We do have high standards. Not least, for example, in rights at work. And I addressed that in my speech here today to say, look, better rights and protection for people in their workplace are good for growth. So we're clear where we stand on standards. But we're future looking, we're pragmatic, and subject to those standards, then yes, we do want investment into the United Kingdom because we desperately need growth in this country. We haven't had meaningful growth in the economy in the United Kingdom for 14 long years. We're determined to turn that around.
But just to be clear on that, so the government would need to be sure that Shein's not using forced labour in Xinjiang before it could list in the UK?
I'm not going to get into individual businesses. What I will say, and be very clear about it, standards and high standards do matter to us. So, of course, we'll be looking at any issue that goes to high standards, with a particular feature on the rights of the workforce. We've been really clear that we see that as two sides of the same coin when it comes to growth. Good employment rights and protections, and a lot of drag on growth. They're fundamental for growth, and I think pretty well all good businesses understand that, which is why in many cases they've already put in place some of the rights and protections that we are bringing forward in legislation.
On China, and you had an interesting conversation with Eric Schmidt this morning that touched on China. I'm interested, right now we have the Chinese army holding drills around democratically governed Taiwan, which they admit are a rehearsal or a practice for a full naval blockade of this place that produces most of the high-quality advanced chips in the world. I'm just wondering, we have the Foreign Secretary on his way to Beijing later in the week. Do you worry about the timing? Do you worry about the signal that sends on a week that the army is literally practicing potentially an invasion or a blockade of Taiwan?
Well, the approach I'd take is this, that national security has to come first. So that's the number one priority. And therefore, of course, we challenge where it's necessary to do so. But we're also pragmatic, and we want our country to move forward and to succeed. So challenge where it's necessary. But there are areas where...
It's not necessary when they're drilling this kind of practice.
Challenged. We do challenge. I myself spoke to the President. We do challenge where it's necessary to do so. But, we are pragmatic as well, and we need to make sure that we get that balance right when it comes to our relation with China.
Just to follow up on that, when you say pragmatic, it feels like you're going to be more pragmatic than the previous government. They ceased internet sort of major economic cooperation, the dialogues, other things, when China imposed the national security law on Hong Kong. Are we sort of officially saying we're over that now?
Well, I think the problem with the last government is they veered from one side of the road to the other side of the road and then back again, and that just led to a pretty chaotic approach. I think everybody understands the national security first approach that we must take and will take. Everybody understands that we do challenge where it's necessary to do so. But equally, when it comes to, for example, climate change, we're going to have to work with countries like China because it's the only way that we can all go forward.
Prime Minister, we've run out of time, but thank you very much for joining us. Good luck with the rest of the summit.
Thank
Back
you very
to you in New York.
All right, and that was Bloomberg's head of economics and government, Stephanie Flanders, speaking exclusively with UK Prime Minister Keir Starmer, of course, speaking at the Global Investment Summit in the UK. Very interesting conversation. But let's get back to the U.S. market right now. Of course, we are 15 minutes into this Monday trading day. You do have green on the screen. Of course, that rally continuing to build on your big benchmarks. The S&P 500 currently up 0.5%. This would be a 46th record close if that holds. The NASDAQ 100 up 0.8%. Small caps not feeling the love today, of course, currently down about 0.2%. We're ignoring the bond market because it's closed, but that stock market, it's open and it's higher. This is Bloomberg.
Happy Columbus Day.
This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Earnings season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
NVIDIA earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to Bloomberg Open Interest. Let's take a look at this stock market as gains continue to build at the S&P 500 level, currently up about 0.6%. Of course, big tech rallying in force today, and that's part of the reason why you see the Nasdaq as your outperformer, currently higher by about 0.9%. Certainly helps that you have NVIDIA a little bit higher this morning. The Russell 2000, your small caps, really fighting to stay green, failing so far. Your small caps currently, I'm going to call that unchanged. As we were just discussing before the break, of course, the bond market is closed today. Maybe that's a little bit of a relief given how volatile things have been over there.
I'm going to look ahead to earnings now, Katie, because we have $4.6 trillion worth of stocks reporting just this week, even more in the next 2 weeks. Last week was a strong start for earnings season with the banks helping lift that S&P 500 to all-time highs. We're going to bring in Jess Menton from Bloomberg News right now. You know, Jess, it's interesting this morning, over from Nick Colas at DataTrack, he makes this point about earnings that before 2020, net margins for the S&P 500 struggled to get to 10%. But now we're looking at 12% margins despite higher rates, lower consumer confidence, elevated recession fears. So valuations are justified. But how much more do margins have to really deliver here to keep at these levels?
And it's a great point because it really comes down to those consumer packaged good type companies and staples, as well as those kind of retailers when it comes to the discretionary type space, because coming out of COVID, that's the ones that were hit the margins the most. And then also healthcare companies, for instance, a couple quarters ago, those expectations from Gina Martin Adams over at Bloomberg Intelligence that most of that, right, exactly, so popular here at Bloomberg, that most of the pain was passed because there was a lot of accounting issues with healthcare companies like Bristol Myers in recent quarters. So when you're looking at healthcare, consumer staples, as well as some of those retailers in the discretionary space, that's where you're supposed to see it improve the most. But those expectations, of course, when you're looking overall for the third quarter, if you look at that Bloomberg Intelligence data that they were crunching here, expectations for growth for the year-over-year period is supposed to be just over 4%. So that would actually be the weakest if you're looking at growth in about 4 quarters. But we've seen this strategy before where you've seen analysts lower the bar on those expectations, because for some context, if you go back to June and July, the expectations for the third quarter growth would have been above 8%. So if you lower the bar, more likely you're going to see companies beat those expectations. And Bank of America already is starting to see that.
I was going to say also executives too. I mean, we talked about JP Morgan all last week lowering the bar for themselves. Then you think about Goldman tomorrow. You had David Solomon say last month that trading isn't going to be as impressive.
Right, but it seems the consumer continues to surprise to the upside. I went to a stand-up paddleboard witch festival this weekend.
Oh, okay.
In Sleepy Hollow.
Should I even ask what that is?
Wait, where was this?
In Sleepy Hollow.
Okay.
So basically a bunch of witches out in the Hudson on stand-up paddleboards, and they had food trucks and face painting and kids games, but the lines at every sort of event were so long, hours-long waits. You know, I've noticed this at every festival that I've gone to over the 4th of July. You know, any weekend in Bronxville, it's absolutely packed with tourists looking to spend money.
People are buying popcorn, but are they going to buy a Ford?
Well, I've just noticed that consumer discretionary stocks continue to underperform, right? And I'm not sure if they'll buy a Ford if it's an EV and it's expensive. Apparently not, but they're definitely spending money.
They're buying wands.
Exactly. Well, it depends on where you're looking at within the discretionary space, because you were talking about EV makers and car makers. Obviously, Tesla is in the discretionary sector of the S&P 500, but so is Amazon and other retailers like that, or even if you're thinking about Home Depot and those types of home improvement type companies. So those, if you're an Amazon or a Home Depot or a Lowe's, some of them have seen obviously better margin growth as well, but then other corners of discretionary too haven't as quite as much. So that's kind of the conundrum there, where are you looking at when it comes to discretionary?
I do like using the witch festival as sort of the bellwether for the consumer overall.
It is spooky season.
Let's talk about the rest of the market though, because of course big tech is going to be in focus next week and really this entire earnings season. I'm looking at your notes. You post that outside of the Mag 7, and if you take a look at profits, expected to decline 1.8% in the third quarter. That's anemic, it feels like. Is that really going to be rocket fuel to fuel this broadening?
And that's what we've talked so much over the past year, and we saw a lot of that broadening, especially when earnings growth as well as what translated to those stock prices in the other 493 in the S&P 500. But when you're looking at the third quarter, some of the growth, because in the second quarter, the other part of the S&P 500, actually the earnings growth was around 9%. So when you have a little under 2%, you're kind of wondering, well, can this continue? But if you look at further out, so toward the end of this year, also the beginning of next year, the rest of the S&P 500's earnings growth is supposed to be in the double digits. So it's supposed to narrow for big tech, but be more in line. But again, I don't want to say that, growth when it comes to AI is slowing down too dramatically here, because the year-over-year base effects, say with NVIDIA, with that blockbuster revenue forecast a little over a year ago, when you were coming down from such a low base in 2022, that was obviously during the bear market, and there was an earnings contraction at that time, the base over base effects were so much higher. So now it's just harder to beat that. So that's why you're seeing that narrowing growth when it comes to big tech.
It's interesting. There's so much optimism. We have to talk about the risk. Where are the sectors that you expect the most pain?
It's actually energy. So when I was talking about how we've seen those expectations come down so much for the third quarter in recent months, it's energy that was cut the most. And a lot of that had to do with, probably not surprisingly, when it came to the performance of crude prices in the third quarter being lower. So because of that, that's where you're seeing that. And then beyond even just energy, it'd be more kind of commodities focused type industries like materials as well. So that's where you're seeing more of the pain. So when we're talking about the other corners of the S&P 500, it's not broad based where you're seeing the earnings estimates coming down. It's more energy and then followed by materials too.
But bottom line, so energy is crazy that they can't even get more than $80 a barrel for Brent,
right?
Even amidst an escalating war in the Middle East. And I think today's OPEC report highlights that, growth is really slowing. I mean, 2% is not even as good as Disney World in terms of visitor growth. But in terms of the other 493, I see that we are expecting less than 2% profit growth for them, but it would be the second consecutive quarter of profits. They had almost 10% profit growth in Q2, and you're saying going forward, double digits.
Right, so the beginning of next year, so the first quarter in 2025, that's where it's expected to be above 10% growth, and then that would be kind of coming in more in line with the rest if you're thinking about the Mag 7 kind of cohort and where the earnings growth would be.
But they're slowing, right?
They are.
Their growth is slowing.
So the third quarter would be around 18% growth for a year-over-year period, and for some context, in 2023, their average was around 35% growth for those 7 type of companies.
All right, a lot of numbers, but you can read all that stuff if you go on the terminal or Bloomberg.com, search for Jess Menton. You can also type BIGO on the Bloomberg terminal for all of Bloomberg Intelligence research. Coming up in the next hour, Pat Gallagher joins us. He's chairman and CEO of maybe the biggest insurance brokerage you have never heard of. Gallagher coming on next to talk about the aftermath of the hurricanes. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so check us out there. Alex Steele, Paul Sweeney with you. Coming up here, Christina Hooper, Chief Global Market Strategist at Invesco. She's going to be in our studio. We'll get her thoughts on those markets. Gina Martin-Adams as well, Chief Equity Strategist for Bloomberg Intelligence. That is a 1-2 punch on markets, that's for sure. Benedict Kamel, Bloomberg Aviation Editor on Boeing's endless doom loop. Gives no respite for the new CEO. It just seems like every day comes out, there's more bad news for our good friends at Boeing. We'll get the latest reporting there. Let's kick things off this hour like we do with Mr. John Tucker.
All right, Paul and Alex, this report being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. Treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. S&P 500, record territory, major stock averages. Overall, mixed right now. You have 5 of the 11 major industry groups in the S&P 500 higher. Technology, that's in the lead. Vistra, the best performing stock in the index. BNP Paribas started coverage on the power producing company. They have an outperform rating at a street high price of $231. The S&P 500 finished last week at, as I say, another all-time high, and it did this without relying on the Magnificent Seven. Meantime, Chris Harvey at Wells Fargo sees a decent environment for equities.
We're looking at a situation where the Fed's cut 50 basis points. Yes, rates are going a little bit higher, but they're still pretty low. I think it looks like GDP for third quarter is going to be around 3% if you follow the Atlanta Fed. And now you're having earnings that are okay. That's a recipe for higher stocks, and that's what we're getting.
Data compiled by Bloomberg Intelligence shows strategists predicting just a 4.3% increase in profits for the S&P 500 companies in the third quarter. Let me finish up with Caterpillar right now down 2.5%, getting a skeptical eye on Wall Street. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Hello. How are you guys? Happy Monday.
Absolutely. We're here.
All right. I'm Alex Steele, John Tucker, Paul Sweeney, Bloomberg Intelligence Radio. 46, guys. 46 record highs now. If
Really?
we close at this level. Yeah.
Okay.
I'm keeping track. It's like something I feel like I can do every day.
Good.
So
Very good.
We're going with that. In the market, though, it's quite interesting to see the lack of small cap participation. Mid caps continue to also climb, but it's the smalls that continue to underperform. We want to get more insight here on the market action. Here is Abigail Doolittle, Bloomberg Markets senior reporter. All right, Abigail, what are you looking at today?
That's a really interesting point, Alex, that you're making on small caps. That Russell 2000 right now flipping between being unchanged and small losses relative to the S&P 500 up a very healthy 0.7%. The NASDAQ 100 up 1%. And what comes to mind for me is the top of the GFC for the small caps. At the time I was working with Hugh Johnson Advisors up in Albany, and he was sort of pulling out what little hair he had.
You worked up in Albany?
I did.
You in Albany?
That's where I grew up.
Is that right?
Yes.
I just thought
was
of you as a New York City person.
Yeah, well,
Okay.
I was
Like
born
Alex.
here, and my family is down here. But no, I was always jealous of my city cousin kids, or the city kid cousins that we would come down and visit. In any case.
We are awesome.
Yes.
Uh-huh.
Yes.
Go ahead.
There's something there for sure. And he was very agitated in August of 2007 because the Russell 2000 was rolling over. And at that time, I hadn't been there long enough. I didn't understand markets well enough, but I came to understand that he saw that as an early sign that there were problems with the markets. And he started reducing client portfolios at that time. No, this is not an ad, and that firm doesn't exist. And it's that current name, but they are still great. And so the fact that we still have the Russell 2000, its last all-time high was back in 2001, and yet we have the chips up strongly with NVIDIA higher again. Apparently the demand for Blackwell and the production looks a little bit better than what folks had thought. And in fact, that stock does appear to be breaking out. And then you have the transports down. You know, there's this bifurcation again where growth is climbing and value less so. How long can this keep going? But the fact that you do have those small caps weaker for such a period of time and in the range where it will rally that index in those small cap stocks, you know, giving people hope. It's not a scene of volatility. It doesn't mean that what happened in the GFC is going to happen, but it's certainly something to keep an eye on. So I'm glad that you pointed that out, Alex.
And I'm looking at the movers for the NASDAQ today. It's kind of the names you'd like to see leading this market. NVIDIA, Apple, Microsoft, Meta, and Google are the top five. And it's kind of like the old days.
It is.
We want that? I thought we didn't want that.
I like that because see, my thing is I can't remember the time when tech didn't lead this market higher. So if tech's not leading it, I kind of feel like I don't have any.
I get that.
I don't know.
Well, given the weighting for the NASDAQ 100 in particular, the MAGA, I think it's about 50% of the index. So if those stocks are higher, the index is going to be higher, explaining that 1% gain. Now, to Alex's point, though, you know, for that diversification, that broadening out into the value, when are we going to see it? When is it going to be a broader base rally? What stands out to me is that it's almost like a seesaw. When tech is higher, the funding is coming from some of those more value names. When the value names have a little bit of a recovery, the tech is down modestly. But overall, it has just kept, you know, the index is going higher at this point. It stands out to me, Tesla down again. It had been earlier higher, down 1%, down for a fourth day in a row, of course, falling 8 or 9% on Friday. Folks disappointed by the lack of detail around the robo-taxi idea. It's possible that investors are missing something there in the fact that, yes, for the near-term stock action, they should just basically be relying on the current Tesla financials. But looking forward, that could be a tremendous growth driver, even without the details today. It's just going to take longer than folks think. So that stock's shedding about 1% right now.
Before we let you go, let's go Southwest for a second. So that stock is down by about 0.8%. Elliott apparently requesting a special investor meeting. What does that mean?
They are. So there's a proxy battle. Elliott wants to gain 8. They, of course, want to basically redo the airline or make improvements to create shareholder value, which it's interesting that they're choosing an airline. I always just think about the airlines and the fact that Warren Buffett will never invest in them. I don't know if he has since the lieutenants kind of coming in, but I remember that old knowledge. In any case, Elliott wants 8 board seats. It's their first proxy battle since 2017. This is the first special meeting that they've requested requested. So it sounds as though they have some new information to discuss with this company. I don't think that the conversations have been so friendly. The CEO and the Southwest Airlines management, to my knowledge, has not really said that they're trying to necessarily work with Elliott. So let's see whether or not this special meeting, whether it happens and if it can become a little bit friendlier.
This notice is Elliott's first for a special meeting, as well as its first proxy battle since 2017.
Yeah, pretty amazing.
They don't do this thing very often.
No, they
just
don't.
buy stock and then say, I want change.
Which makes it more interesting that they're doing it with, again, Southwest Airlines, which was, I think that they've never quite recovered from that technical debacle. Was it 2 Christmases ago?
Yeah,
I think that they...
And it's the way that they have their systems.
Yes.
And then it takes a lot of money to replace the systems, but that's sort of the issue there.
Yes.
All right, Abigail, thank you very much. Appreciate it. Abigail Doolittle joining us from Bloomberg. So I don't know if you know this, guys, but $4.6 trillion worth of market cap is reporting this week. It was the third, I think, busiest week for the S&P in terms of earnings. John Tugger, super pumped. So I was reading Gina Martin Adams of Bloomberg Intelligence. He's a senior chief equity strategist, I should say. And they were kind of taking that broader look on the earnings season. And she had a really interesting point. And Gina, this is why I wanted to get you on and talk about it. You guys say that if you look at guidance by the firms, looking at about 16% earnings growth, but earnings growth by analysts sees significantly less. Is that kind of gap weird?
It is unusually large. What we do find, Alex, first, thank you for having me on. Thank you for reading the work.
Oh, always. I'm a fangirl.
What we usually find is that companies' guidance is a pretty good proxy for what to expect during the earnings season. Analysts over the last several quarters have underestimated earnings, have also undershot guidance. Not by this huge of an amount, though. For instance, coming into the second quarter earnings season, analysts were expecting about 8% earnings growth. Our guidance model was saying 12. We ended up getting 14. This time around, analysts are expecting nearly 4% earnings growth, and our guidance model is saying 15, 16. So it's a very big gap. I think a couple of things really explain the gap this time around. The first is, when you look at the sector concentration of guidance, only about a fifth of S&P 500 companies tend to guide earnings. That surprises a lot of people. It's not every company gives us guidance. We have to rely on a small subset of companies for this analysis. But nonetheless, of those about 100 companies that give us guidance, most of them are tech, communications, and consumer discretionary companies. So they also are concentrated in certain sectors. Now, tech and communications in particular, we know are the strongest segments of the S&P 500. We've seen that play out over the last year and a half. The weakest players in the S&P 500 are energy companies. They're still producing double-digit declines in earnings. Analyst consensus thinks they're going to give us another 20% drop in earnings year over year. They don't give us guidance at all. For the most part, they're just absent in the guidance trends. So that we could have a sector skew happening. Nonetheless, that sector skew existed last quarter, and it gave us pretty good indication that analysts were too bearish.
Maybe it's just, I want to, under-promise and over-deliver from my buy-rated stocks. That's been known to happen,
Once or twice.
Yeah, once or twice. I'd never did it, of course. But,
No, of course not.
Yeah.
Talk to us about the Magnificent Seven and their presence in the marketplace in terms of taking this market higher. How important are they still, and maybe from an earnings perspective, too?
Yeah, well, clearly the market moves higher faster when the Mag 7 are rising, right? When the Mag 7 are leading, as we saw for the vast majority of the last year or so, the market moves up at a faster pace because they're the bigger stocks. They're the biggest market cap weightings. They do matter. You can, however, have periods of time in which the Magnificent Seven are not leading the market and you still have gains. The third quarter was a good example of that. The Mag 7 really sputtered a bit in the third quarter. We saw rotation move into other stocks. Other sectors started to break out in the month of August, reaching new highs when the Mag 7 was still struggling beneath its former peak, and stocks still rose. But the rate of appreciation in the S&P 500 does shift when your smaller players are rising faster than your bigger players. The worst case scenario is the Mag 7 falls. It's really difficult for the index to make gains when the Mag 7 is selling off because they're so big. In particular, tech and communications as whole sectors are gigantic. They're 40% of the market cap of the index.
Oh my goodness.
So when those stocks are struggling, it's very difficult for the rest of the S&P to recover, particularly at this stage of the cycle when you still have commodity prices and commodity-linked sectors operating as a drag on index and a drag on index earnings. You do need some stability in the rest of the index to overcome that earnings drag and that price drag. But they are still important. It's a matter of degree of importance. And, they're very important to the rate of appreciation in the market. They're very important to the overall trend in the market and increasingly important also as a driver of earnings growth on the S&P 500.
Right, because of the hyperscaler situation. Like the more CapEx they spend, the more it trickles down into other sectors and other companies as well. What kind of CapEx spend from the hyperscalers do you think we're going to see for next year? And how does that compare, say, to this year? And is that like a disappointment? Like what is good and bad? I'm using air quotes.
Yeah, I don't have any specific numbers on the hyperscalers in particular. I would lean on our analysts in order to sort of derive those type of nuanced expectations or micro expectations. In terms of macro, what we're seeing is companies have realigned their capital spending in line with their sales. So CapEx ratios, CapEx to sales ratios across the S&P 500 are very close to normalized now. We're looking at still double-digit capital spending growth, but that's down from extreme rapid capital spending growth coming out of the recession that we had in 2022. The vast majority of that improvement has come from tech and communication stocks, but you're seeing across the board more normalized capital spending, with the exception, again, of energy, where this is just a big drag on the index. The commodity-sensitive segments of the index are still experiencing low CapEx relative to sales. I do think that tech is a big portion of the overall optimism with respect to CapEx, but it's not the only thing happening. Healthcare is another area where we should see improvement in capital spending. Financials have been somewhat reticent to improve their capital spending pace as we've been quite cautious, or many financials managers have been quite cautious with respect to the outlook. That group is starting to talk about spending on AI, for example. So that's something to watch going into 2025. The long story short is CapEx will still likely contribute to growth and likely contribute to overall optimism. The only area where we may be spending a little too much is in tech and communications, is among these companies where they've ramped up spending so fast. Sales now need to spend a little bit of time catching up to accommodate that spending pace.
So what sectors are screening well for you guys these days, Gina?
Sure. It's a combination, a strange combination of cyclicals and defensive sectors. We actually still have both tech and communications, the giants in the middle of our sector scorecard. That happened for the first time in several quarters back in June. They dropped out of the leadership position on our sector rotation model and have been kind of sitting in the middle. Instead, it's more segments like healthcare, which was a big laggard last year, still a growth industry, but a little bit of defensive quality. Real estate is toward the top of our sector scorecard. Even some of the consumer stocks in the consumer staples group screen as relatively well-positioned given the dynamics of sectors right now. And interest rates seem to be driving a lot of choices because financials and utilities are toward the top of the scorecard as well. So the fact that the Fed is reversing policy, creating a potential improvement in lending conditions, also that rally in the long end of the curve, reducing pressure on some of the high borrowers in the index, does seem to be characterizing the sector scorecard to some degree. At the same time, recovery in laggards. So recovery in earnings laggards such as healthcare, real estate is starting to show up.
All right, Gina, super appreciate it. It was a really great piece. I love digging into all your research. Gina Martin-Adams, she heads up our equity strategist coverage for Bloomberg Intelligence. Only the best for you guys here at Bloomberg Intelligence. And we get Netflix this week. Is that
we do?
Is that early?
No, it's just that the other media companies are always so late.
They're late.
Yes.
I see the distinction. So that's going to, I've been hearing about potential price increases on the ad tier and the non-ad tier. I wonder if that's going to kick in now or if that's a 2025 thing. What are we thinking about that?
I think we're just, aren't we paying more all the time? I mean, I just go into my phone periodically and I just
delete them. I do the same thing.
Yep.
Right.
So,
but then
I
it's
mean,
like that one show that
that's
I need
right.
to
Then
have.
you're like, oh, I need that one.
Right.
Yeah,
And then it gets
exactly.
really confusing.
Yep.
Tuck, how about you? Do you have streaming?
Not really. I'm very cheap, so I refuse
What?
to
We've
pay for
established
it.
that before.
If I can't get it free, then
Do you have bunny ears?
it's not. Yeah, it's a fact. I do.
You do? Yes. Okay.
Well, I just had two of my offspring independently ask me if I can get them special like access to Bloomberg.com, and I said no. Pay for it. You pay for content.
Yeah.
That's how you roll.
Come on, man. Grow up. Pay for that content. All right. Coming up, we're going to talk to Christina Hooper. She definitely pays for content. Chief Global Market Strategist over at Invesco. We'll get her take on this market. We're looking at 46, the record high for the S&P. This is Bloomberg. Happy Monday.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 climbing to a fresh all-time high. It's How many?
46. Well, okay, if we close, 46 record closes.
Okay, 46. Tesla, that is lower right now. Those shares down 1.5% after last week's 13% plunge. Disappointment over the robo-taxi. Apple climbing. You had a bullish analyst call. And NVIDIA, that is the most actively traded stock this morning. It is up 3.1%. Treasury cash trading, that is closed today. More key companies delivering results this week. That includes Goldman Sachs, Netflix, J.B. Hunt Transport Services, and again, strategists predicting that companies in the S&P 500 will post their weakest results in the past 4 quarters, with just a 4.3% increase compared with a year ago. Caterpillar also on the move today. That is down just over 3%, something of a bellwether, downgraded to underweight by Morgan Stanley. Analysts view construction firms cautiously, flagging a disconnect between fundamentals and the share price at this point. The S&P 500, 36 points higher. That's up 0.6% at 58.51 on the index. The Dow Jones Industrial Average, that's turned positive, 17 points higher right now. And the Nasdaq 100 is up 170 points, a rise of 0.8%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. And that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Alex Steele here alongside John Tucker and Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. Those bond guys are still sleeping, but we're here and we're definitely working. Also working, Christina Hooper, Chief Global Market Strategist over at Invesco. She joins us now in studio. Christina, I keep joking, but yeah, okay, it's 46 record highs potentially if we close at these levels for the S&P. Do you buy it? As in, are we climbing a wall of worry? Or is this like a fundamentally lead-driven rally, and do you buy it?
I do buy it. So for a few reasons. First of all, we have central banks at our back. And it's not just the Fed easing. We have a number of central banks easing. It's an environment of accommodation, and that is supportive of risk assets, including equities. And I would argue that is the single largest driver of markets right now. But we also have an economy that is on pretty solid footing in the United States. And actually elsewhere, not so bad either. We're getting stimulus from China. So I think the global picture is quite good. But in particular in the U.S., I think that this is an economy that is going to slow only modestly and then is going to quickly reaccelerate probably by the end of this year, early next year.
All right, given that background, stocks versus bonds, let's start there.
So I think there's a place for both in one's portfolio. It's important to be well diversified. I would err on the side of an overweighting of stocks relative to bonds, but I still see an attractive picture, especially now that yields have backed up as an entry point for fixed income. This is an economy, I mean, in a normal environment, what we would see is the Fed cutting as an economy is in bad shape. This is a very different scenario, so we can go out on the risk spectrum when it comes to fixed income as well.
Isn't the reacceleration, though, a risk? Because if you get really reacceleration of growth and inflation, that means actually the Fed's going to have to revert and start hiking again. Is that a scenario for you?
Well, that's certainly a risk, but I think it's an unlikely risk right now. And I'm looking at 6 months out, and what I see is an attractive picture for equities. And let's face it, if we get to an environment, I think what's much more likely is that we have a Fed that slows down its easing. And I'm very comfortable with that because it's slowing down its easing for good reason.
So what do you think the Fed will do for the remainder, on the next 3-4 meetings maybe?
So I think that for this year, we're probably only going to get 25 basis points more. And I'm very comfortable with that through the end of 24.
Okay.
And then I think we will see continued easing next year, and we'll probably get maybe 100, 125 basis points if all goes well with this economy, which, knock on wood, will happen.
If we do, Tucker, did you have something?
No.
Oh! I thought
I'm
he was
just talking to
me.
myself.
Oh, okay, good. It's a distinction we need to make here in radio.
Ignore the man over there.
So, but if we only get 25 for the rest of the year and we have to price that out, does that cause turbulence in the market, or do you think then earnings will be strong enough to show, guys, we're good?
I think so. We have gotten only a little bit of earnings season thus far, but my takeaways are that the consumer is quite strong. Yes, there's weakness in lower income consumers, but the overall picture is a positive one. companies are in pretty good shape. There are plans to do more business travel next year. We're seeing a lot of different areas of real strength with a few pockets of weakness. So I think that absolutely can be the picture and can, I think, encourage investors to continue to move stocks higher this year.
So are there sectors here that you want to play here? Because I'm just looking just at today's action. You know, the best performance has been some of the tried and true Mag 7, the NVIDIAs, the Metas, the Googles of the world. Are you comfortable still making that play, or are you looking for value or in other parts of the market?
So this is an environment that will support a big tent under which many asset classes can exist. Although I do think the greatest potential from here are the smaller caps and the cyclicals because they are so closely correlated with the economy. And if you believe there's going to be an economic reacceleration, then, and I would argue for at least a modest overweighting of the cyclicals and the small caps.
It's interesting you say that because we had an article out today on the Bloomberg that talked about how the Russell is still, 10% below its record highs, but the small cap 600, which has more exposure to, say, quality, is almost near that 2021 record. So is there a distinction within that small cap space?
Well, I certainly think there is a distinction right now, but that could change. Again, we are just at the start of what could be a significant economic reacceleration. So I won't dismiss parts of the small cap universe. What I would say, though, is that right now, as there is still some hesitancy and apprehension, there's a fair amount of uncertainty about a lot of different things, including what the Fed's going to do and who's going to win the presidential election. We're likely to see more of a focus and a desire to be in quality.
INGO, the Bloomberg Index browser, shows me kind of how the fixed income market is behaving, even though they're not working today. By far, the best performance has been U.S. corporate high yield. Is that played out, or is there still opportunity there in high yield, do you think?
I think there's opportunity there. It's not a surprise to me. In fact, I go back to the last time the Fed was able to successfully tighten and avoid a recession. So that was 94, 95. They began to cut in 95, 96. And if you look at the first 6 months of performance for a variety of different asset classes, as the Fed started to cut, high yield bonds did very well in that period. And I'm not surprised because they were cutting into a good environment, not dissimilar to where we are today.
Do you think that the post-election makeup will be a headwind or a tailwind? I can see a case for both, right? You get a headwind, corporate taxes and tariffs. The tailwind is uncertainty removed in some capacity. Therefore, there's been CapEx, companies on the sidelines not doing stuff they want to do, and therefore they go do it. Which camp are you in here?
I think it's going to be a net positive because we are going to see people coming off the sidelines. We saw in the Federal Reserve Beige Book, and we're hearing it in some of the earnings calls, that there are companies and consumers that are sitting on their hands right now. And so I think that encourages them to come back in, spend more. So I think it's a net positive. Also, I hearken back to the view that it is the Fed that is a far more important driver.
Earnings just starting here. What do you need to see from corporate America this earnings season?
Well, I think they're going to beat expectations. That's what we need to see, and I think it's going to be very easy to do that. Expectations have been managed well, have been essentially downwardly revised, and so it's going to be they're going to be able to beat expectations by a significant amount, and I think that's really all we need to see. Also, I think it's important, the guidance that we get for the future, and I think we will get relatively positive guidance.
Can we broaden out for a sec? Sure. Where else outside the U.S. is a good opportunity?
Well, I'm excited about UK equities.
What? Said no one literally ever that I've spoken. That's not true. One or two people maybe in my time. How come?
Well, valuations are very attractive.
As they have been forever.
Okay, but the catalyst is that we are now in an easing cycle, and that certainly will be a helpful driver. It's also an economy that's actually in relatively good shape. Now, consumer sentiment has turned negative recently, and I think what we're seeing is a sitting on of hands, not dissimilar to the U.S. right now, because everyone's waiting and worrying about the autumn budget. But once that has been released, I think we can move on from there, and that could very well be a catalyst in and of itself.
We just had Keir Starmer on saying that the UK is open for business.
I bet he did. Yeah.
So,
yeah.
All right. So, AI. It seems like the AI hype in the market has kind of faded a little bit. Now people are starting to think about, I don't know, mundane things about getting returns on investment and use cases and so on and so forth. How do you guys at Invesco, how do your tech people, what do they tell you about AI and what you should be paying for it and how you should be getting exposure to it?
Well, when we think about AI, it's really about how it can help companies and how it can help the economy, as opposed to, I'm not thinking so much about myself. And so I'm excited. I think that certainly there has been a trend towards overinvestment in AI. But companies are making a rational decision and saying that it makes sense, that the opportunity cost of not investing, that risk is far more significant. And by the way, there are some ancillary benefits to investing, that it structurally improves their technology in general. And they're better poised for the future as a result. We're already seeing that companies are getting benefits from their AI investment. On an earnings call last quarter, I believe it was Walmart that talked about how AI has helped with online sales. And that is not an anomaly. A number of companies are seeing that. And that's just the low-hanging fruit. I think we're going to see AI pay dividends for years to come.
So pause into AI, and I want to talk about China, ex-US there. So just quickly, we have about a minute left. If you're talking about a global easing cycle, in essence, with the exception of Japan, does China fit that bill for you?
Absolutely. It is a very stimulative environment right now in China. And it's not just monetary policy. We're getting fiscal stimulus as well. And I think that is very compelling.
A lot of China folks felt like it wasn't enough. And I guess some people are saying, yeah, maybe it's not enough, but there's more to come, so don't worry about it. I mean, I don't follow that closely. Do you? Is it?
So I think it's more about we don't have enough details yet. Although I'm excited, they're slow rolling out details, but everything we've heard thus far suggests these are going to be more structural reforms aimed at supporting the economy over the medium and longer term. So we might not get that immediate payoff, but as details continue to emerge, I think the picture will get more and more positive.
Right, they're just not like cutting checks right now to like help stimulate. It's a little bit more nuanced. Christina, it's so good to see you. So thanks so much for coming in. We really appreciate it. Christina Hooper, Chief Global Market Strategist over at Invesco. All right, coming up, we're going to go to our big take story of the day. It's catastrophe bonds, not catastrophic. I can't read today. Cat bonds. I like cat bonds.
Yeah, exactly.
Will help Florida but fail Jamaica. We're going to try to understand what all of that means, and are cat bonds still going to be an asset class to invest in? Bloomberg ESG editor will be joining us. Gautam Nick joins us next. He will be joining us right after this break. Looking at the markets here, S&P still up by about 0.7%. Nasdaq up a full 1 percentage point. Volume though pretty light on this holiday Monday. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 building on its record that was set for Friday. Right now, of the 11 major industry groups, 8 of them are higher. You have gains for NVIDIA, Apple, and other big tech stocks. That's leading the way. Bank of America, Johnson & Johnson, United Health Group, they're all going to report their latest results tomorrow. Later in the week comes United Airlines, Netflix, American Express, Procter & Gamble. Troy Gajewski at FS Investment says there's been some concern whether companies can grow their margins faster than their spend on artificial intelligence.
And what we've seen is they continue to do so. And even if there is some compression in their margins, it looks like equity investors will give them a pass for the time being because there's so much belief in the growth potential in AI.
Right now, the S&P 500, 0.7% higher, up 41 points, 58.56 on the index. The Dow Jones Industrial Average up 44 points, and the Nasdaq 100 is up 190 points, up about 0.9%. Some of the other shares on the move today, Boeing shares, they continue their slide. They're down 2.3% in the first trading day since the aerospace giant warned that it expects to report that it burned through $1.3 billion in cash during the latest quarter. Oh, by the way, today is the first time in 18 years, this only if you're a Mets and Yankees fan, that the Mets and Yankees have played on the same day in the postseason. So it's like a trifecta of sorts because you have Yankees, Mets, and also the Jets are playing tonight.
Oh, that's
Monday
amazing.
Night Football.
I feel like I learned something there. I'm going to use that like throughout my day.
Oh,
for
sure.
trivia, water
you don't
cooler
even have
talk.
to attribute.
I won't. Thank you. John Tucker, Alex Steele, Paul Sweeney. This is Bloomberg Intelligence Radio. Every day, Bloomberg puts out a big take. It's great stuff. You can get it on podcast. You can get it in print. You can get it on Bloomberg.com and on the terminal. And today's big take story is cat bonds will help Florida but failed Jamaica. So that story is part of Bloomberg Green's investigation into how climate change is making parts of the planet uninsurable, leaving millions of people without a safety net. And the point is that governments and companies aren't prepared. And this is part 3. So we wanted to turn to Bloomberg ESG editor Gautam Nick, who joins us now. Walk us through this part 3 of this series that you guys have been doing.
Sure. Good to be on the show. So essentially, this particular story I've done with a couple of colleagues looks at catastrophe bonds. These are a bet on the probability of huge natural disasters like earthquakes, wildfires, floods, or hurricanes. And obviously the incidence of some of these events has gotten higher, and the severity of some climate-related events like hurricanes and floods have become more intense. So these catastrophe bonds are a way for insurance and reinsurance companies to pass on the risk of growing disasters onto Wall Street, onto the capital markets, and not to put it on their own balance sheet. The way it works is that if you're an investor in the bond, you can make a very large return that could be hard to find in another fixed income product. However, if the particular disaster that's defined in the bond does occur, then you could lose some or even all of your invested capital. So it's a gamble on a weather disaster.
Very simply, do these work?
Yes, they absolutely do work. So just to give you the broader context, about 70% of all catastrophe bonds are focused on the U.S. windstorm sector. It includes hurricanes and other severe named storms. And a big chunk of that relates to Florida. Obviously, this came into focus recently because of Hurricanes Helene and Milton back-to-back that caused a lot of flooding and wind damage as well. And the way it works is that if a particular threshold of losses is met for most of these catastrophe bonds, then the issuing party will get a good chunk of the money. That's taken out from the money that the capital markets, the Wall Street investors put in when they bought the bond. And that money then goes to fix people's roofs and, rebuild homes.
When has it not worked? As I mentioned, the title was they helped Florida but failed Jamaica. So what's the scenario where they don't pay off?
Yeah. So catastrophe bonds have been around for about 25 to 30 years, and they've largely developed, as I said, in the US, but also in Europe and Japan against earthquake risk. But increasingly, institutions like the World Bank, the IMF, the OECD are trying to popularize them in the developing world. Now, this is a part of the globe that is being disproportionately hit by a lot of climate losses to which they're not directly linked because, most of the emissions have come from since the Industrial Revolution in the western parts of the world. But a lot of these weather disasters are being, focused on the, southern hemisphere. So the World Bank and other institutions are trying to get developing countries that are facing these risks to issue these catastrophe bonds that have been around in the West. But there is a problem. The way the bond is structured in the West, the way it's developed, seems to work quite well. But in a developing country, because they don't have an insurance market, you can't actually calculate the total claims on an insured basis. So they've come up with a different way of structuring the bond. It's called a parametric approach. Basically, for a hurricane, it would simply be if the pressure of the hurricane hits a certain threshold, which indicates wind speed, then the bond will pay out. But if it misses, you get nothing. Even if you miss by the tiniest fractions, the rules say you will get zero. And that's sort of what happened with Jamaica.
It would seem like if you believe in climate change and if you believe that weather's going to become more and more unstable, it might be really hard to price the risk out here because it seems like the risk would always be going up of more and more, again, unstable weather and catastrophes here. How does the market account for that?
You've pinpointed a problem. So when someone's trying to calculate the risk of these kind of weather-related catastrophe bonds, all you have really is historical data. So for hurricanes, you have 150, 170 years of pretty robust data going back, and you can make a good estimate. But unfortunately, the calculation has been muddied now with climate change, and these forecasts are, of course, forecasts. It's something that hasn't happened yet that will project it to happen, but you just don't know how it might unfold depending on, how the world reacts to increased CO2 emissions. So the whole question is, how do you incorporate the climate effect into this historical data and provide a really reliable metric for someone to make a financial bet on? And it's the uncertainty of, well, to some extent, the models that are used. They're by no means perfect, but also this extra new element that we've seen in the last few decades of climate change.
So you guys, as I mentioned in the beginning, this is part 3 of a series that you guys have done into how climate change is making the planet uninsurable. What is your key takeaway here?
I think one of the main takeaways would be that it is very hard to accurately model the risk of climate change. And of course, there are attempts being made to refine it constantly. But if you're trying to insure a large proportion of the world that is not insured in the developing world, also parts of Europe. I mean, there's a huge insurance protection gap in Europe and even in the US. For example, in Florida, insurance companies are moved out. They're not providing insurance. In California, for earthquake risk and wildfire, they're moving out. So the main takeaway is that it's becoming a more difficult problem. It's becoming a more uninsurable planet because of climate risk.
All right, Gautam, thank you so much. We appreciate that. Gautam Naik, ESG editor for Bloomberg News, joining us on Zoom from London. You can read Gautam's story and more from Bloomberg The Big Take on the Bloomberg Terminal and at Bloomberg.com/Big Take. Some good stuff there, some great reporting, some great graphics. I always like the graphics folks do some great jobs to bring the stories to life there. As well, illustrations for this story by John Preventure for Bloomberg Green. Like to call him out. So, yeah, I would think, boy, if I'm trying to structure a bond, I'm like, I don't know what the risk is of this thing. It just seems like it's getting worse and worse every year.
Well, here's my question then, too, is that say you're able to finally figure out the correct structure, right? Then the weather changes again.
Yep.
So then how do you manage that part, right? So just because you might have, huge windstorms in one area now, are you going to have them in 15 years? Or are you going to have solar issues? Or is it going to be floods? It's something different. Then how do you manage that?
Yeah, if I'm an investor in these bonds, I'm like, you better pay me a huge rate.
Which they do, to be fair. Yeah.
Okay, so yeah.
All right, well, coming up, talk about paying for risk. Boeing? I don't know.
Yep.
Yeah?
I like it.
Sure, okay. We'll talk more about Boeing and the doom loop it's in.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Live Radio, and that's where you find it. Boeing, BA Equity Go on your Bloomberg terminal. It's down 1.9%. Again, it's down 43% year to date. Just can't seem to get a break there. Most recently, the playmaker announced job cuts and some pretty big charges they're going to be taking. They announced that Friday, nice Friday data dump, news dump there. Benedict Kamal joins us, aviation editor for Bloomberg News, joining us from Berlin, Germany via that Zoom thing. Benedict, talk to us about Boeing here. Can you step back and say, what does this company need to do? Can they do it? Can they right this ship? Because this feels like a company that, just for global aviation's perspective, it's got to work.
Yeah, you're absolutely right. So many things that have to happen to get the company back on track. They need, first and foremost, they need to get production back up. That's not happening right now because the workers are on strike. That means that production of the crucial 737 plane, that's the sort of the aircraft that we all use to do these short routes, that plane is not being produced, and that is the plane that makes money for Boeing. They need to get that production back on. They need to figure out how they they want to look going forward. Can they be everything to everyone? Can they have a viable defense business, a viable space business, a viable commercial aviation business? Is that a realistic proposition given where they stand right now financially? And also, crucially, they need to get their finances back in order. This is a company that has just about $10 billion left. $10 billion is their crucial mark in terms of running their day-to-day business. And they said on Friday in that data dump, as you said, Paul, they had $10.5 billion left in the bank, as it were. So they're just above that very crucial threshold. And that really raises some serious questions about how can they keep going at that level? The strike is costing them money regularly. By some estimates, it's about 100 million a day, and we're now in our 5th week. So these are all the things facing them, and there are some things further out that I won't bore you with, but the list is endless.
Right. That's not even like longer term fundamentals at this point. So are you saying that we could see a breakup or like a spinoff of some areas of this business, as you were talking about? Do they need to be in all of these businesses right now?
I mean, this is a little bit of speculation at this point, but there was something from Kelly Ortberg, the relatively new CEO, that was tucked into the Friday announcement, and I'm paraphrasing a bit here, but it was essentially saying we need to figure out and we need to decide what is core to Boeing, what we are good at and what we are less good at, and where we need to put our resources and our focus. And if you think about that and sort of think forward, that might suggest that indeed the company shouldn't be everywhere. Should it be in the space business? You might remember most recently the space business has been in all sorts of negative headlines, mainly because of the 2 astronauts who've not come back on that ill-fated Starship. So that's a question that's out there. Are there areas within the defense business they might need to hive off? So a lot of questions swirling around that comment. You know, what is really the core of Boeing? Might we, in an extreme case, be cruising towards a breakup of the company and a focus on really the profitable and core business, which is commercial aviation?
So I guess, you know, one of the questions here, well, I guess I'd like to ask, you know, what are the customers saying? What are the customers of Boeing? What are they saying about their support for this? Because, you know, the United Airlines, the Southwest Airlines of the world, they need Boeing to be, you know, healthy again.
Yeah, you're absolutely right. So on the one hand, ever since this latest crisis erupted, the view from the customer side has been, we need Boeing to function. Nobody wants Boeing to go under, and it won't go under, because this is a duopoly between Airbus and Boeing. There are essentially 2 major companies out there making these planes. So we need Boeing to function. That's the view from the customer side. Why do they need Boeing to function? Because they need their planes. Right now, they're not getting those planes, and that's something that's really rippling through the industry. Talk to any airline executive, and they will tell you, we are flying older planes longer. We are not getting the planes that we ordered, that we wanted. That is hugely complicated for our fleet planning. We have to retrofit older aircraft. We have to actually take out some routes. This is really causing major headaches for these companies. Interestingly, today we got a pretty sort of harshly worded statement from Emirates, their president, Tim Clark. Now, he doesn't usually mince his words, and he can be fairly straightforward with Boeing because he's one of their biggest customers. And he said, we're going to have very tough conversations with this company in the next couple of months about their delivery schedules. We are not sure the company can make any realistic predictions at the moment. On Friday, for instance, Boeing said that their 777X, that's a big wide-body aircraft, that would also be delayed into 26. Now, originally, just to give you a bit of perspective, that plane was scheduled for 2020. So we're 6 years late if and when they finally get it out of the door. Now, 2020, try and remember what you were doing then. That's a long time ago. So that's when the plane should have arrived, and it didn't, and people are still waiting, and everyone's saying, give us those planes. We need them. And frankly, Airbus is also saying, we need the competition. We don't want to be the monopolist in this market. We also need a functioning Boeing out there. So everyone's rooting for Boeing. but patience is also running thin.
Yep, and also time is of the essence, right? Because there will be, and there are smaller Chinese suppliers that are kind of growing as well. So at some point there will be more competition, just not right this second. Benny Campbell joining us. He heads up our global aviation coverage for us. All right, coming up, we have much more for you in the next hour. Directly after this, we'll go to Jerusalem. Dan Williams will be joining us. He's a reporter there on Hezbollah attack in Israel. Plus, Mike McGlone will join us from Bloomberg Intelligence on the move in commodities. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business and economics and finance. For the next hour, we have a great hour lined up for you. We'll go to Mike McGlone to talk about the moving commodities. He's Bloomberg Intelligence Senior Commodity Strategist. Plus, Rich Greenfield. I'm just honestly going to let Paul talk to Rich, and I'm just going to learn stuff. Partner and co-founder at Lightshed Partners on all the media news. Plus, you got Netflix earnings later on in this week. And Nathan Dean, a Bloomberg Intelligence Senior Policy Analyst, will join us on the political news of the day, of which there will be many. And we'll keep an update on all the stock moves as well. In the meantime, let's get you caught up with a Bloomberg Business Flash. For that, we go to John Tucker.
All right, Alex, this is Bloomberg Business Flash being brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. If the advance in the S&P 500 holds up today, it's going to be the 46th record close this year. NVIDIA leading gains of the chip makers, and then you have Apple climbing. You had a bullish analyst call there, and the parade of earnings continues. Key companies going to deliver results this week. They include Goldman Sachs and Netflix. Investors looking to see what can propel stocks next. That's according to Jack Caffrey at JP Morgan Chase.
Things are pretty good, but I think you're starting to see some broadening out. You're seeing people looking into bigger ticket consumer purchases. Some names leverage the capital spending, the second derivative, if you will, of the AI trade. Not that the first derivative has been bad at any stretch of the imagination, but investors are looking for what can you do for me next.
Well, the S&P 500 30 points higher, and that's up 0.5%, 58.45 on the index. The Dow Jones Industrial Average of 49 points, that's a rise of 0.1%. The Nasdaq 100 97 points higher, and that is up 0.5%. The shares of Adobe, they are up about 2.5%. Adobe unveiling artificial intelligence tools that can create and modify videos, joining some of the other big tech companies and startups trying to capitalize on demand for the technology. And then OPEC trimming its forecast for oil demand growth this year and next. For a third consecutive month, the group belatedly recognizing a slowdown in global fuel use. NYMEX crude, American crude, is down 1.5%, 74.41. Brent crude is down 1.5%. That was like 280-ish at the Wawa.
This is huge for you. Huge.
Oh, it's huge.
Huge.
Yeah. Now we get he doesn't have congestion pricing. He defeated that single-handedly.
Huge.
And now we just got to,
I'm, batting right now.
He's flush with cash.
Yeah. Where's our breakfast and snacks and stuff?
All that extra some cash flow.
Party on JT
from the 6th floor. All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Global Radio, Bloomberg Live Radio. It'll find you. You'll find it. Let's see what's happening in the markets today. We got some green on the screen after some mixed futures. Natalia Kenijevic, equities reporter for Bloomberg News, joins us here in our Bloomberg Interactive Broker Studio.
It wasn't bad. It wasn't terrible.
Like a B minus.
First of all, yeah, A.
A.
No,
But she's so nice.
oh, she's
She's an A.
easy
It was kind
grader.
of a C.
Absolutely fair.
Easy grader. All right, Natalia, what are you looking at here in the equity markets today?
Yeah, let's start with movers. So we see that Canada Goose is up it was up by almost 4%, down, sorry, excuse me, by almost 4%. Now it's flipped earlier gains. But basically, Wells Fargo downgraded the stock. And they cited two things. They said that there's a weakening global brand heat and weak macro environment in China. And earlier, Bloomberg Intelligence also said that Canada Goose's ambition to expand globally and across different outwear categories could be really, really pressured by weak consumer demand. So it's a consumer story.
Yeah, so they make expensive stuff, guys.
And it was like, what was that, 5 years ago, 7, 8 years ago, when it burst on the scene? Everybody had it.
Is Canada Goose the one that, like, the sneakers are, like, messed up, but you buy them messed up and they're like $800? Or am I thinking of something else?
Something
else? Okay, this is the code. Okay, great. I'll go school myself in that. It's because I can't wear the sneakers because of, my plantar fasciitis. Okay, next up, you're looking at B. Riley. I know, I'm like an 80-year-old woman inside. B. Riley is up by 22%. What is going on here?
It's a huge move, but guys, keep in mind, it's a very low base. Last year, I think in July, the stock was about $60. Now it's $5.43. So it's a huge move, but we should also compare with previous performance. So basically now the company said that it's ready to sell majority stake in its Great American Holdings business to funds managed by Oak Tree Capital Management. The company, B. Riley, will get more than $200 million and get 47% of common units of its reorganized Great American business. But overall, we could put it this way, it's a big battle between short sellers and shareholders. Short interest is still huge, and there are a lot of negativity when it comes to this company. They're still delaying second quarter earnings results, so analysts are still waiting for that, and there are lots of concerns related to this company. And yes, we will see how long this positive move will last.
And to finish up, what you do so well in the equities team is talk about positioning and sort of where the flows are, where their funds are. For example, like CTAs, commodity trading advisors, and volatility control funds, risk parity funds, because they kind of got to go with the flow, like literally. What is the latest on positioning?
Right. I would start with hedge funds because it was pretty big move last week. Hedge funds bought U.S. single stocks by the most since 2021. Really? It's also interesting to look at across different sectors. Huge interest in healthcare stocks, followed by financial industrials. They still buy information technology, but it's really important to look at a subsector level. They buy software, but they still sell semiconductor stocks. So, and then to your question about commodity trading advisors, last note I saw from Morgan Stanley trading desk, and they see a little bit of positivity, and they see that CTAs, which follow market trends, of course they don't care about fundamentals, they are expected to buy U.S. stocks pretty aggressively over the next couple weeks. So that's the big picture on that.
All right, Natalia, thanks so much. We really appreciate Natalia Knežević joining us, Bloomberg Equities reporter. Thank you so very much. It was the news all over the weekend of what's happening in Israel. It's twofold. One, Hezbollah attack kills 4 as Israel digs deeper into Lebanon. At the same time, the U.S. is going to ramp up its and replenish its missile defense system, and U.S. soldiers will be there to support that. We want to get more on the ground with Dan Williams. He is a Bloomberg reporter joining us from Jerusalem. Dan, can we just start with the missile defense system for a second? What's the readout on the ground as to the why and what it means?
I think this is a high-performance, high-velocity proof of U.S. support for Israeli security. We heard about this only yesterday from the Pentagon, and now we're hearing that as soon as tomorrow, the first parts of the system will be flown in. It could be up and running within days. I think the Biden administration is trying to show here that it's aware that Israel's air defenses may be overstretched. Indeed, just a few minutes ago, there were sirens across central Israel, apparently millions of Israelis taking shelter as Hezbollah launched more missiles toward that area. So I think the Americans here are trying to show the Israelis that though there may be disputes about policy, about strategy, when it comes to core defense, they're there for it in very short order. Hence the quick dispatch of this very expensive, very advanced, high-altitude missile interception system.
Dan, what's the latest reporting on a potential Israeli response against Iran?
That's anyone's guess. The closest we have, given that the small number of Israeli officials who are in the know are not speaking. In fact, there are rumors they're even all required to sign special non-disclosure forms to ensure that they would not leak. But Israel's finance minister, a man who's hawkish on security, was on the radio this morning, and he was asked if he is satisfied with progress in preparations for Israel's response, whatever it is. And he said the short answer is yes, and I can't give any details. It would appear there is still momentum. It would appear that the Israelis are keeping their cards very close to their chest, which is unacceptable. They've been very open about their plans. So at least on a tactical level, they seem to be preserving secrecy. So it could be imminent. To judge from public statements, it will be significant and it will be imminent. Perhaps that's one of the reasons that this American system is on its way here, to make sure the Israelis have a way of dealing with the retaliation for the retaliation should it come.
Well, to that point, that's what I was wondering. Like, can we look at that as a deterrent against Iran, or just anticipating an Israeli response will be so bad that Iran will have to respond, and that will be so bad? Is there a sense as to which way that's going?
I think that's a very smart question. Certainly, deterrence is an angle here. I imagine the Iranians will have to think twice. It's worth remembering the United States isn't just shipping the system over, they're bringing it over with some 95 to 100 U.S. military service members who will operate it. So you're going to have a fairly large number of U.S. uniformed personnel in Israel, potentially in the line of fire. And that may give Iran pause when it decides on an attack. By the same token, this is a lesser issue, but I still think it's significant. Israel may now believe that it has to cooperate fully with the United States on any plans it might have. It's lost any unilateral option on going to war against Iran in the face of U.S. disapproval, in the face of a U.S. veto, if you like. It'd be very hard for the Israelis, on the one hand, to host this very expensive, very advanced system with staffed by U.S. personnel, while going solo in an action against Iran that could have untold consequences for everyone in Israel, including U.S. personnel.
All right, Dan, thank you so much for your reporting. Always appreciate getting some of your time during this fluid situation. Dan Williams, he's a reporter for Bloomberg News based in Jerusalem. He just reported that central part of Israel had come under just attack just minutes ago, and Bloomberg's reporting that, or the IDF is saying that all the threats are intercepted after central Israel sirens. So that's the latest reporting there. All right, let's switch gears, get to the commodity business, because we talked about the tensions in the Middle East. One of the areas that we see it in the financial markets is in commodity prices, particularly global energy. And for that, we welcome our next guest. We're talking to Mike McGlone from Bloomberg Intelligence. He's a senior commodity strategist. Mike, how much of the Middle East tension just over the last several weeks, how much of that has moved into the price of global oil, then maybe starting to move out a little bit?
I think it's more the latter, Paul. It's moving out. On a one-year basis, Brent and WTI are both down about 15%. And gold's up almost 40%. So from a commodity standpoint, they're kind of pushing back on the potential for a major disruption of supply of crude oil and focusing more on the tilt towards a global recession, particularly with China leading. Now, that was all the story this weekend about China's stimulus, but the fact that we're completely dependent on that stimulus and completely dependent on more cuts from OPEC and the U.S. stock market going higher is probably a problem for overall commodities. So crude oil, I think the risk is it's potentially tilts lower, and it probably needs at some point some kind of definitive supply reduction, maybe from, hopefully not from some kind of attack. Otherwise, I think it's going to continue to trade lower.
Well, that's the interesting thing about looking at geopolitical risk within the futures market. It's like, would we be so much lower if not for geopolitical risk, or should we be much higher because of geopolitical risk?
Well, Alex, I'm glad you went right to the futures market, because what's happened in futures is lately what's going on in commodities. It's not more of, it's much less of a market of broad commodities and individual commodities, and that is managed money net positions. Hedge funds got record short Brent crude right when it printed 68, the 3-year low just about a month ago, and now they're back normalized. They're not really short anymore. So the market got way too short. It's tilted back, and that's happened in broad commodities. Broad commodities had priced in a severe recession, got short for the first time ever in our our data going back to 2011. Now they come back to more normal. So positions, what really drives the market, are back to more normals. They've covered their shorts. But as far as geopolitics, the key bottom line I've been saying for a while, there is no definitive sign of a sustained cut in supply. In fact, what's happening is keeping prices a little bit elevated, and it's adding fuel to what's been pressuring prices since 2008, and that's the excess of supply of the U.S. and Canada. Yet at the same time, what's happening in China, we see the same demand imports of crude oil from Japan, around 11 million barrels a day. It's the same as around 2020. That's really never happened. So they're actually declining, and we see this technology revolution. 50% of sales in China are EVs, and you're seeing it everywhere. Every country in the world has to put tariffs on those cheap EVs. So the trajectory, I think, for crude oil is to follow what natural gas did. It got cheap. It got to the same price as 1990. And it follow what grains have done. They get to their cost of production. And according to BNEF, the cost of production for WTI in this country is $56 a barrel.
Mike, we got some fiscal stimulus out of China over the weekend. Some folks are saying it really wasn't enough. What are the commodity markets telling you?
Same thing. The commodities. So it's tilt over. Commodities are telling you the same thing. It's not going. I don't think it's going to be enough. It's like they have deleveraging issues akin to maybe much worse than Japan had 30 years ago. So in the meantime, the decisive enabler of a war in their best customer's backyard, according to NATO. So I think that deleveraging is just getting started. But the key thing I think to look for commodities for signs that maybe it's working is copper. And copper, Dr. Copper, is bumped up against $10,000 a pound. It's holding back. It's dropping back down, and I'm fearful it's going to do what it normally does. They use the word autocorrelation. In the trading pits, we used to say, well, it goes down because it went up. And copper has to stay strong for this indication of stimulus out of China to work. And I'm fearful it won't. And another key indication is what's been really driving copper is what we mentioned earlier, is managed money net positions, i.e. hedge funds. They're really long copper. About 30% of total futures open interest on the LME and CME is long copper. To put that in perspective, when copper peaked just a few months ago, the new high was 32%. And typically it drops to negative. So I'm worried that specs are way long copper, very optimistic, and they're more likely to be disappointed.
Well, that's a great point, because you also bring up copper. It's still a cyclical commodity in a structural market, because no one can argue that longer term copper's not a great bet, because you have the long-term demand pull from the energy transition, and that's global, right? However, you're still structural, and that's providing a weird sort of gap or mushiness with prices. Technical term.
That's a great word, Alex, and you just absolutely nailed copper. The key thing I love of what you said, it's such a known in the business. Everybody gets it. Just make the example. Copper made a new high this year. Crude oil didn't. Copper made a new high 2022. Crude oil didn't. We get the trend, but as you said, it's much more in the cyclical nature in the global economy, and you got to say copper and China in the same sentence. And I think it's more indicative of what we saw Japan did 30 years ago. It's just China is in a pretty severe deleveraging, and copper and even iron ore are both telling you that this deleveraging is probably just getting started.
All right, Mike, we appreciate it. Thanks very much. You can come on and tell me that my question was good anytime. Yeah, we appreciate that.
So Mike has never complimented me.
Okay, but you have Rich Greenfield next, so that's going to be a whole Paul Sweeney is awesome thing. All right, Mike McGlone, thanks a lot. Bloomberg senior commodity strategist for Bloomberg Intelligence. So coming up, Rich Greenfield, partner and co-founder at Lightshed Partners, will be joining us on any recent media news. Paul and him are just going to talk about a lot of stuff, and I'm just going to learn a lot of things. Also, Nathan Dean will be joining us, Bloomberg Intelligence senior policy analyst, on the political news of the day, which is more campaigning, more policy promises. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages, they are higher right now, adding to the record from the close on Friday. The S&P 500, you have 10 of the 11 major industry groups in the S&P 500 gaining right now. With technology shares, they are in the lead. NVIDIA on track for its first record close since June. Those shares up 2.8%. Vistra, the best performing stock in the index. BNP Paribas started coverage on the power producing company. They have an outperform rating and a street high price of $231 per share. And the S&P 500 did finish last week at yet another all-time high. It did this without relying on the Magnificent Seven. Also records the equal-weighted version of the S&P 500, or Bloomberg's index of other 493 large-cap stocks, including the Mag 7. Data compiled by Bloomberg Intelligence shows strategists predicting just a 4.3% increase in profits for S&P 500 companies in the third quarter. Right now, the S&P 500 up 37 points, and that's a rise of 0.7% at 58.52. The Dow Jones Industrial Average up 116 points. That's a rise of 0.3%, and the Nasdaq 100 up 136 points. That is up 0.7%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
Hi, JT. Thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube. That is the internet, I've been told. Go to youtube.com, search Bloomberg Live Radio, and that's where you will find us. I covered the media industry for a long time, and boy, when I was covering it, everybody was making money. But man, the last 7, 8, 9 years, it's been a really tough place for investors to find consistent shareholder returns. And the big challenge for global media has been this thing of cord cutting. I mean, it used to be such a great model when 100 million American homes were paying, $100 a month for all kinds of 500 channels and all that kind of stuff. But since the cord cutting has really escalated or accelerated over the last several years, it's been really a tough business model, and the companies are trying to adapt, investors are trying to adapt. And I'll tell you, the analyst who called this out first, in my opinion, and the loudest, highlighting it as a risk for global media, was Rich Greenfield. He's a partner and co-founder of Lightshed Partners. He joins us here. Rich, again, from my perspective, you were absolutely one of the first, if not the first, to really highlight this cord-cutting risk for global media. Can you step back and help us think about where we are today and where we go? Because I'm just not sure when and if to invest in a media company anymore.
Well, look, I think it's really hard. There's no doubt that cord cutting has accelerated, and because cord cutting has accelerated, all of the legacy traditional media companies have all jumped headfirst into streaming. But as they've done that, they've actually, to make the streaming services compelling, they've pushed all of their great content to their streaming services. So you don't, outside of live sports, there isn't a whole heck of a lot that's really compelling. Sure, you've got news if you care about MSNBC or Fox News, although even CNN you can now get as part of Max. And so the number of things that you need the traditional bundle for has really shrunk pretty dramatically. And I think, as you get more and more streaming services with great content and all the original content that you can't find on linear, it's pushing more and more people to cut the cord. Or even if they don't cut the cord, maybe they're a subscriber for part of the year, but nobody signed up for Comcast or Charter Spectrum. Nobody used to sign up for 3 or 4 months. Now you can, signing up for YouTube TV for a few months is easy. You can watch for football season, or if you love postseason baseball, go sign up. Then you can cancel. I mean, it's just so easy to come in and out. But
it's
those dynamics are so different from the way it was, where nobody called up Comcast to have them rip the equipment out halfway through the year.
So to that point, I feel like saying this is going to get me in trouble somewhere. Why is linear TV still a thing?
Linear TV is, I honestly think the only reason there are 67, 68 million homes paying upwards of between $75 and $120, probably $5 a month, is live sports. I mean, sure, there's definitely an older demographic that has been doing it and, will never churn. But I think the reason why you have millions subscribing to YouTube TV and Hulu Live and continuing to take Comcast is for live sports. I mean, if you want to watch all football games, college, pro, you need a subscription to cable, satellite, or one of these over-the-top YouTube TV bundles. There's no getting away from it. You still can't. Sure, can you replicate a bunch of it in streaming? Yes. Next year you'll be able to get even ESPN direct to consumer in September 2025 when Iger finally pulls the trigger on that. But if you want to watch Fox Sports, Fox football games yesterday afternoon, there's only one way to do it, which is sign up for a bundle.
All right, Rich. So if I am the management team, if I am the board level at some of these linear media companies, what do I do? Is there ever a world when I can generate the profitability and the returns that I did 6-7 years ago, or is that model just gone?
Look, I think if any of these companies was able to get up into the top echelon, to be a dominant player in streaming, that's certainly possible, Paul. I mean, I wouldn't think saying never is sort of difficult. But right now, I'd say all of these traditional media companies, the one thing they're struggling with is they're really optimizing for the wrong thing. They've been focused on, initially they were just focused on subscriber growth.
Yep.
And so they just gunned it for subscriber growth. Profitability didn't matter. They were just, losses were piling up, billions, I think, between all of the major companies. I think they were losing upwards of $12 billion if you aggregated it all together between Disney and Warner and Peacock. So they realized that's not sustainable. So now they've been, slashing the amount of programming, slashing the marketing, raising the price. And the thing that they're all missing is they're not gunning for time spent. Netflix never wants you leaving. Amazon never wants you leaving. I think the challenge for all of these companies is they're stuck in this weird middle of they don't have enough scale. They don't really have the balance sheets to invest aggressively because they're dealing with, just as you were talking about at the beginning of this interview, the pressure from cord cutting on the linear business. We didn't even talk about advertising, which is under pressure. So your core business is under pressure. It's very hard when your core business is under pressure to deploy even more capital to really gun it in the new business. And so you're stuck in this sort of what I would call this sort of ugly middle where you don't have enough scale, you haven't hit scale, and you don't really have a clear path. You're sort of hoping for consolidation, whether that's streamer consolidation or whole company consolidation. But it is certainly a very difficult place to be. And I think if you look at this stock, all of these stocks as a group, it hasn't been pretty. I don't care whether it's Warner Brothers Discovery or Disney, even Comcast. This whole space has not been a great place to make money. And I don't think in the next 12 months, do I see any green shoots or some major change that's going to make you say, oh my God, this space is on fire? The answer is no.
Hey, Rich, before I let you go, Tom Keene wanted me to ask you here, Warner Brothers Discovery. Can you give me 30 seconds on that name?
Look, it's David Zaslav has to prove to Wall Street. This is purely a David Zaslav execution story. They didn't renew the NBA. Yes, they're suing. I think there's highly unlikely to win that suit. But the key question for the future of WBD, Warner Brothers Discovery, is was dropping the NBA or not renewing the NBA, is that existential? Because if they can get their deals done with Comcast and other distributors over the coming year, then getting rid of, what would have been $2+ billion of cost is a home run for the stock.
I see. Okay.
Investors don't believe it. Investors believe that this is a catastrophic loss, that they're going to get maybe not dropped by Comcast, but a severe reduction in fees. And so this is purely, can David Zaslav prove to investors that they are strong enough to withstand the loss of the NBA?
Yep.
You're going to find out over the next 6 months.
All right, Rich, always great to talk with you. Really appreciate you taking a few minutes of your time. Rich Greenfield, he's a partner and co-founder of Lightshed Partners. Let's switch gears, get back down to Washington, D.C. We are down to 22 days, I think, until we get the election.
It's like 10 market days? I don't know. It's something.
Let's go to Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. Nathan, again, 22 days to the election. What are the good folks in Washington, D.C.? What are the talking points these days?
So this is actually a quiet time right now in Washington because everything's happening out on the campaign trail. I mean, we saw Vice President Kamala Harris today just release another round of proposals, this in an effort to attract black voters. But some of those proposals were interesting in terms of supporting marijuana legalization. There was talk about enhanced cryptocurrency regulatory frameworks. So even though we're only 21 days before the election, these policies are still coming out. Now, on the flip side, you have President Trump. You know, President Trump hasn't been really releasing new policies per se, but is certainly continuing to push the message. But in terms of like who's going to win and so forth, this is going to be an extremely tight race. I was just playing around on the terminal a few minutes ago, and if you look at the charts of the Electoral College, pretty much every week you have a different winner. So this is certainly going to be very, very close and very tight.
You know, 8 years ago, there was the secret Trump vote where no one was saying they were voting for Trump, but then they did. I'm starting to hear more of there's a secret Harris vote. Is that a thing?
You know, I think so because, well, look, the best way to look at it this way is that President Trump has always had a ceiling in terms of his support. It's around 43 to 44%. Nobody knows what the ceiling is for Vice President Harris. So there's this thought out there that she could go potentially higher. But one of the charts that we were playing around with this morning just shows you the number of independent voters that are still undecided. And amongst those 7 swing states that matter, you're looking at somewhere between 0.5% and 2%. So this is really a race about turnout. This is President Trump versus Vice President Harris versus the couch. And if the couch wins and people stay home, President Trump will very likely win. If people come out and vote and we see record turnout, then Vice President Harris will win. But I was joking with a colleague who works at the House over the weekend. This could come down to the state of Pennsylvania and whether there's a snowstorm in Pittsburgh or Philly. It's going to be that close.
Not the storm thing. Every time, oh, it's raining, therefore. But there's early voting now. Doesn't that make a difference and all that stuff?
Absolutely. I mean, obviously, you know, I said that tongue in cheek, but, you know, early voting is certainly something very important. We've seen both candidates call for their supporters to go out and do that. So, you know, but, you know, the message is essentially that there's going to be 150 to 170 million Americans that are going to vote in this election. But ultimately, it's going to be 100,000 amongst those 7 swing states that are going to decide who the next president is. So, you know, the other thing to keep in mind is that, you know, polling is extremely tight. But over the last couple of election cycles, you've seen the actual results be a little bit different off that polling. So what I mean is, if polling says it's going to be like essentially a tied race, you know, the last 2 elections have shown that actually the real results shows that it's usually 2 or 3 percentage points a different way. So you probably could get a clear winner come, you know, the week of the election.
All right.
I don't know. This is going to be wild.
Okay. I don't know. I don't have the energy, and I don't even cover politics. All right, Nathan, thanks a lot. Nathan Dean, Bloomberg Intelligence, Senior Policy Analyst, joining us on that. All right, coming up, it is our weekly Bloomberg VNEF segment where we're going to talk about all the amazing things about green transition, energy transition, and sustainability. Kyle Harrison, BNF's Head of Sustainability Research, will be joining us on that. Taking a look at the markets, we are still grinding our way higher, but off the highs of the session, the S&P is up by about 32 points, up 0.6%. The NASDAQ up 0.6% as well, up 121 points. This is Bloomberg Happy Monday.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 climbing toward a fresh all-time high. It'll be the 46th this year if this holds up. Apple climbing on a bullish analyst call, and NVIDIA, right now those shares are leading gains for the chip makers, up 2.3%. NVIDIA shares roaring back yet. The company successfully calmed investor concern about product delays. The stock is up 13% so far this month, on track for its first record close since June. And earnings season picking up this week. Lori Calvasina at RBC says the important message from the company earnings so far is that the consumer is in pretty good shape.
I really look at the big banks for read-throughs on the broader economy, and I thought that what we heard from a couple was really an endorsement of the soft landing thesis. We had one of the banks basically say the consumer is still in great shape. We had another one saying, look, we're looking for signs of this consumer weakness, and we're just not seeing it.
Among the results this week, Goldman Sachs Group, Netflix, J.B. Hunt Transport Services. And this headline I'll bring along to you. The Labor Secretary, the acting Labor Secretary, Sue, is in Seattle, Washington, scheduled to meet with Boeing and its striking machinists union, trying to get something going there. Shares of Boeing right now down just about 1%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Alex Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And every week around this time, we tap our amazing resource over at Bloomberg BNEF, previously known as Bloomberg New Energy Finance. BNEF basically tracks everything that you need to know, from commodities, power, transport, industry, buildings, ag, as well as how to finance the energy transition. And joining us now is Kyle Harrison, Head of Sustainability Research at Bloomberg BNEF. He joins us now. So let's take a look at corporations and how many and what kind of corporations have signed green PPAs, known as power purchase agreements, which is basically like they're getting their electricity and power and stuff through green things.
Exactly. So they're locking into long-term contracts for typically solar or wind power, but we're now seeing them expand into other forms of low-carbon technology. For example, like nuclear, like hydro, and like geothermal. Big technology companies have really led in this space. So it's the companies like Amazon, Meta, Google, Microsoft. They're signing the most deals at a large scale, but we're seeing a lot of heavy emitting, hard to abate sectors getting into this space now. So materials companies, industrials, oil and gas companies, they're starting to break into new markets where big tech maybe doesn't have as big of a footprint, and they're starting to sign these long-term, large-scale clean energy deals.
Where are the clean energy deals happening? Is it here in the U.S.? Is it in Europe? Where are these things mostly happening?
Historically, it was the U.S., so between 2015 and 2022, around 2/3 of all these corporate clean energy power purchase agreements were signed in the United States. In 2023, that number dropped to around 45%. So corporations are increasingly spreading out and signing deals in Europe, in Latin America, and Southeast Asia, for example. In Asia in particular, you have a lot of demand for electricity from corporations, and you have a huge supply chain footprint. And historically, those companies haven't been able to buy clean energy, but through a lot of policy lobbying and a lot of work on the ground with regulators, you now have opportunities to buy clean energy in Japan, South Korea. Vietnam's a new market, so there's a lot of new exciting expansion.
What's the price for these things, and how do they compare to traditional energy?
So that's been one of the biggest drivers in the growth of this market, right? So through September of this year, companies have announced over 31 gigawatts of clean energy through corporate power purchase agreements. That's the size of a small country in a given year. And we're on record pace, and the biggest reason for that is that solar and wind on a new build basis are now cheaper than coal and gas in many markets around the world. So as a corporate buyer, I can undercut those prices for power that I might be paying, for example, from a utility or from the grid by locking into a long-term fixed contract for renewables.
And for renewables, is the adoption of renewables or the growth of the renewables market, is that driven by the market or by regulations, government saying you got to do this? What do we learn?
I mean, to the last question, it's really primarily driven by economics, but reliability is a huge factor here, right? So big technology companies, they're now going out, They're building these data centers. You're seeing a big expansion in manufacturing capacity. All of this requires the lights to be on 24/7, right? So you can't afford to have a power outage or a grid failure. So locking into one of these contracts for solar and wind, that gives you more reliability. And again, that expansion into other forms of what we would call zero carbon baseload power that could generate 24/7, like nuclear and geothermal, that also kind of emphasizes that reliability. So it's a combo of that along with sustainability.
And how do you think that this sort of partnership and evolution happens? It's still going to be these long-term power purchase agreements, or is it going to be like these hyperscalers and, you know, maybe even like a cement industry or the hard-to-abate industry just sets up like their little small modular reactor right next to their facility, or a wind farm right next to their facility? I mean, I'm hyperbole, but you get the idea, versus plugging into the grid, for example.
You definitely need collaboration on the grid side, right, and the utility scale side of this market. Of course, there are opportunities to build a solar project or a wind farm on site and leverage energy storage to get that power directly. But we need utilities, right? And we need grid planners to start collaborating with these corporate buyers to ensure that this grid scale up is done sustainably. If we start to build all these hyperscaler data centers in, for example, the data center corridor in the eastern US or in Texas, you need to ensure that there's enough transmission capacity to ensure that that power gets moved from A to B, right? So that starts to involve regulators, that starts to involve utilities. So it really is kind of an approach that everyone needs to be involved in for this to be successful.
You know where they do wind farms in a big way? Ireland.
Ooh,
Driving
did you
around
see
Ireland, tons of them.
Lot of data centers in Ireland as well, so it's extra important there.
All right, so they were everything, just big ones as well, and it's windy there, so it works. Being an island and all. Talk to us about, you mentioned nuclear energy. What's the future of nuclear here in this country? Can we build these little nuclear plants that can do things and not pose a big risk?
So I unfortunately I can't comment too much on nuclear as a technology.
We have a nuclear guy?
We do have a nuclear guy. I'll leave it to him.
This
but
BNEF thing.
What I would
there's
say,
like 5 people there.
what I would say is, right, there was a lot of noise around this announcement from Microsoft around 3 Mile Island.
Right.
3 Mile Island is a name, right? That's a project that obviously evokes a lot of emotion. But we're going to see a lot of corporations continue to look for those deals with that zero carbon baseload power. So we wrote about this the other week. This won't be the last nuclear deal from big tech, right? You'll see more geothermal deals. So it's going to play a really important role here as a reliable source of power that's also low carbon.
What I think I understand, though, from that particular agreement is that the 3 Mile, so Constellation Energy will revamp its nuclear reactor and turn it online into the grid. Then Microsoft will pay the difference to Constellation Energy from what it would cost to get from the grid versus this nuclear facility. So it's like done differently. It's not like the nuclear is going to like plug right into a Microsoft hyperscaler. It's like they're still going to take from the grid. So it's all these like weird agreements that I feel like you're going to have to.
Did I tell you I read a book called The Grid?
Did you?
Did I?
They're joking
very
because
good.
they're very excited about reading The Grid, and then now they think
We're now geniuses on the grid.
Yes, exactly.
As
So
one
anything
should
you want to
be.
know? Just let me know.
Anything, they got it.
Yep.
What region is signing the most of these clean PPAs?
Right now it's Texas, and it's based purely on economics. So in, for example, northern and western Texas, the price of power for wind is incredibly cheap, and you have fantastic wind resources. So you have a lot of companies going out and signing deals there. But increasingly, companies want to emphasize where can they make the biggest impact by adding clean power. If you already have all of this low carbon wind and solar generating in Texas, are you really making that much of a difference by adding another project there? For example, compared to the eastern US, where you have more coal power, right? Where you can have a bigger impact on decarbonizing the grid. So what we're going to slowly start to see is more corporations expand that footprint, both to other parts of the United States outside of Texas, but other new regions in the world as well.
Who burns coal in the US anymore? We still have coal?
Well, I mean, I guess we can follow the lead of the UK, right, which just retired its
that's
final coal project.
But they still have them, right? They're still.
John, are you burning coal there in the abode?
I do have a bag of coal in the basement.
Yes, he does. He's
Don't we all?
John Tucker's going to
I
be the
don't
last
know
coal
if you're
burner.
actually kidding.
No, I actually.
Yeah, that's the thing. He's not. All right. Thanks a lot. We really appreciate Kyle Harrison, the last holdout.
Yeah.
Bloomberg Vianney, as head of sustainability research, joining us on those trends in sustainability. All right, coming up, we're going to talk about deals that we're seeing and the pressure from Elliott when it comes to Southwest Airlines. signs. It feels like there's a lot to be done with the company, and Elliott Management is definitely in it. We will break all of that down for you. This is Bloomberg Intelligence.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. It is Hispanic Heritage Month, and every day at this time we are celebrating significant moments in Hispanic heritage. Now with your installment for October 14th, here's Bloomberg's Lisa Mateo.
And so this month in 2003, the first American Latina fighter pilot for the U.S. Air Force retires from the military. Now, her name, Olga Custodio. She served 24 years in the U.S. Air Force, retiring as a lieutenant colonel. She became the first Latina to complete the U.S. Air Force undergraduate pilot training program. And then after that's transitioning to the Air Force Reserve, she became the first Latina to fly a commercial airliner with American Airlines. But getting there wasn't easy. While studying at the University of Puerto Rico, she was actually denied the opportunity to participate in the university's Reserve Officer Training Program because women weren't allowed in it at the time. But her persistence, determination, it paid off. Today, Custodio, she serves as a powerful mentor, role model for aspiring young Latinos who dream of becoming pilots. Love this story. That's this month in Hispanic Heritage. I'm Lisa Mateo, Bloomberg Radio.
Good stuff, Lisa. Thank you very much. We appreciate that. Lisa Mateo with the it is Hispanic Heritage Month. Crazy story out there. Southwest Airlines, one of my favorite stock symbols, LOVE, LUV for Love Field out there in the Dallas area. They have Elliott Management, Investment Management, calling for a special shareholder meeting, which is kicking off their firm's first U.S. proxy fight since 2017. Let's get the latest reporting on that. Crystal C., Bloomberg U.S. Deals reporter. So Elliott Management Southwest Airlines, what's the history there?
Yeah, so Elliott actually unveiled a stake in June saying that they have a significant position in Southwest, and at this point they have 11% stake in Southwest, which is very, very sizable in percentage and in dollar amount. It worth about $2 billion. What we know here is that Elliott is calling a special shareholder meeting, which is an out-of-cycle investors meeting, and they're trying to elect 8 members into the board.
Does Love, aka that's LUV is the ticker for Southwest, does Southwest have a leg to stand on?
So Southwest actually just put out a statement. They're saying that they have made every effort to reach a constructive resolution with Elliott. We all know that proxy fights are very expensive. They're very time consuming. So I think what Southwest here is saying that they've heard investors' feedback that nobody wants to fight. And it's actually something that's very common in the activism world, that the investor would tell you they don't want to fight, company tell you they don't want to fight, activist doesn't want to fight either, but then somehow they can't come to a resolution, and here we are. The contention, the tension here is really that Southwest has said that they are backing the management, they're backing the CEO, Bob Jordan, and they have already done enough board refreshment, whereas Elliott thinks they need a control in the board to make further changes.
Well, as you point out, I mean, in your reporting here, Elliott's, they do this a lot in terms of activism, but what they don't typically do is take it to a shareholder vote. They usually get what they want, I guess, before then. What's different here, do you think?
Yeah, so they have never done a U.S. Proxy fight since 2017, but this is quite significant in the activism world. They are usually very effective. The second they show up in any stock, immediately the company take them very seriously. They try to come to a resolution because, like I said, proxy fights, lengthy and costly. But Southwest here, somehow it just evolved into this. And that at many points, people thought they could have resolved. But I guess, there's some differences here.
What does Elliott want Southwest to do that Southwest is not doing? Because you would think at this point it'd be like all options, all hands on Southwest deck here.
Yes, so Elliott has asked for 3 main things, which is leadership change, management change, board change, as well as operational improvement. And they've kind of pinned this on the CEO, Bob Jordan, this whole time, saying that he's not the right person to execute whatever strategy that the company has put out. The company has said they would add revenue, they would cut cost. They even had an investor day in late September, and none of that kind of, fulfilled Elliott's demand, which is a majority in the boardroom. So this is where we are, and they're calling it, requesting a meeting for December 10th, which is one of the busiest traveling season in the U.S., in the world, and so it's an interesting timing. And this is also one thing that Southwest is pointing at, is they call this a selfish request in their statement, saying that it is a time where Southwest should be executing.
Southwest, they in July adopted a poison pill. So they're taking this seriously.
For sure. Yeah, so a poison pill is, as you know, something that stops someone from a hostile takeover. And Elliott at that point had close to 10%, and 10% is a threshold to call a special meeting. And the poison pill is for 12.5%, so it stops Elliott from getting more shares than that. And once they do, acquiring more share would become really costly. So it's also a kind of rare occurrence these days. Not a lot of companies put in poison pills, but again, Southwest is full of surprises.
Yeah, tell me about it. Just before you go, when these things unfold, is Elliott management's what they want now? Here's the best bid, but I'll take a little bit less. Or do they really want to replace all these board seats, et cetera, et cetera?
So from our reporting, actually both sides have spent a lot of time trying to figure out how to not go to a fight. Whether we can do Elliott had asked for majority seats. So at one point they nominated 10 directors, and then Southwest came back and said, well, 6 of our directors left. We have 3 seats open. Would you take 3 instead? It's always a constant negotiation. Is it 3? Is it 10? And I'm sure everything has been discussed. Everything on the table has been talked about. And but this is it. This will be up to shareholders to vote on who actually gets the majority in the boardroom.
All right, Crystal. Thanks a lot. Really appreciate it. Crystal C. joining us, Bloomberg U.S. Deals reporter. That's kind of fun. This is fun. It's something to talk about.
I know.
I like it. That wraps it up for me and Paul on this wonderful Monday. Coming up, Balance of Power with Joe Matthew is up next. You still have S&P up. This is Bloomberg.
politics to the world of business. This is Balance of Power. Live from Washington, D.C.
22 days to the election, and the race is tightening. Welcome to the fastest show in politics, with new polling showing the race too close to call in the swing states, and a fight now centering around young voters who could make the difference if, of course, they show up. We'll have the latest on this campaign with 3 weeks to go from Bloomberg's Laura Davison. And we're going to have more on the evolving psychology in the race with Cliff Young at Ipsos out with new numbers driving the conversation over the weekend. Speaking of which, misinformation manifests itself in North Carolina. We'll talk post-hurricane confusion with Bloomberg's Michael Shepard with analysis today from our signature panel. Off the weekend, Rick Davis and Jeannie Shanzano with us, Bloomberg Politics contributors. And it's all after a look at Wall Street. Let's start with our eyes on the markets. As always, right now, an update from Amy Morris. Hi, Amy.
Hi, Joe. U.S. Acting Labor Secretary Julie Su is on her way to Seattle. She's going to meet with Boeing and the union to try to get both sides back to the bargaining table. Su's intervention comes just days after the plane maker unveiled plans to cut 17,000 jobs and take $5 billion in charges. 33,000 Boeing workers have been on strike. That strike now entering its 5th week. Sources tell Bloomberg Elliott Investment Management has informed Southwest Airlines it wants a special shareholder meeting, officially kicking off the activist investors' first U.S. proxy fight since 2017. Elliott reportedly nominated 8 directors to the Southwest board and is seeking to replace the same number of board members. OPEC trimmed its forecasts for an oil demand growth this year and next for a 3rd consecutive month, as the group belatedly recognizes a slowdown in global fuel use. In its monthly report, OPEC said global oil consumption will increase by 1.9 million barrels a day. That's about 2% in 2024. WTI right now down 2% and Brent crude down 2.2%. We do check markets for you all day long here at Bloomberg. The S&P 500 is up 0.7%. NASDAQ up 0.8%. The Dow up about 0.5%. And the Russell 2000 index up 0.4%. The 10-year Treasury yield at 4.1% and the 2-year yield at 3.95%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris, and that's a Bloomberg Business Flash.
All right, Amy Morris, great to have you on the markets today, and welcome to the Monday edition of Balance of Power. It is Monday. Here on Bloomberg Radio, on the satellite, and on YouTube. We're 22 days out. Well, this is pretty remarkable here, with a race that seems to be tightening with time instead of breaking out one way or the other. We're, of course, always following the candidates on the campaign trail as well today, and we're going to be headed back to the swing states. We're getting used to the deal here, of course. Kamala Harris, Erie, Pennsylvania, a little bit later on, is going to be in Detroit tonight. Donald Trump, Oaks, Pennsylvania. You're following along here on your home game with Tim Walz in Wisconsin. He goes to Eau Claire and Green Bay, and we've got a raft of new polling data to sift through here. I don't know if you do the Sunday morning shows. They don't always drive the conversation the way they used to, but much of it centered around this tightening in the campaign at the top of the ticket and the fight over some very important demographics. We're joined by Laura Davison for more here, Bloomberg News politics editor, with a new week. We've only got, can you believe, 3 weeks left of this?
It's about time.
I saw you in there. You're cracking the team together in the newsroom. I don't know where you're deploying resources now, but the campaigns are pretty clear about where they are in the swing states, unless you're doing a California romp or something like that for Donald Trump. But we're going to be talking with Cliff Young in a moment from Ipsos. This has become a 1-point race, maybe a 2-point race, anywhere you look, which means a tied race. Is that how you see it?
That's essentially where we are. And some of these national polls, we saw some new numbers over the weekend, have really tightened. You know, Harris was up maybe 3 or 4 points in some of these, and now it's a 1-point race. Yeah. This is something we see as you get closer. You know, some of those people who are undecided break one way or another. But, you know, some of the momentum and, you know, the pulling ahead that Harris was doing in, you know, August, early September, a lot of that has flatlined now. And this is, you know, going to be a race that is going to be won on the margins. And that's why you see, you know, Trump, for example, reaching out to women this week, holding a Fox town hall specifically geared towards women. Harris this morning out with a plan trying to appeal to black men. So this is both sides are kind of realizing where their weaknesses are.
About where the weak spots are. Do these 11th hour pitches work typically? I mean, we're within 3 weeks here. These are obviously constituencies that we're hoping to get some attention before now.
You know, for Trump, I mean, opinions of him are so baked in that may not move the needle a bunch. You know, Harris has been hearing time and time again from voters, we want to know who you are, we want to know what your policies are. Yeah. So giving people more information, you know, it at least it's acknowledging what people are saying they want. However, that does give your opponent more fodder to attack you with.